Good morning to everyone. I hope you are all fine and, like always, ready to take a course of today. Today is our lecture number 9, which means we have had 8 sessions in the past already. Majorly, we have finished capital gains tax. And from the past 2 sessions, we have been in discussion of inheritance tax, which today will finish. All what we have done in the past 2 sessions on inheritance tax will help us in understanding the topic of today. Once I finish it off, we'll be able to start off with another type of tax, probably income tax. A lot of things the last week we have done. If you have been there, I'm sure you have been there. Most of you, they've been attending the courses live. We have done first chapter, it was on introduction. That chapter of introduction was totally the revision of basic tax, the one that you have studied back into your taxation studies, F6, probably a year or two ago. But that knowledge was as essential as what we are doing it these days, because you cannot understand or progress into that advanced aspects without keeping all the basic knowledge of that topic. And this is something that you by yourself understand. And so I have prepared you for that. Started off with the lifetime transfers, have spent a lot of time, rigorous amount of time in understanding the taxation of pet CLTs, both in the life and upon death. Exemptions, annual, wedding, normal expenditure out of income, annual exemption, interest cost exemption, lifetime taxation 20, 25, 25 in the donor pays, 20% when the donee transfer pays. Due dates of payment, these questions have all been practiced, clearly demonstrating the way that one has to tax the transfer in the life and even on death. A taper relief, a computation of 8. This application 7 was a massive one in which there were 5 transfers, and we have taxed those 5 transfers, first of all, in the life of person and then upon the death. Finally, we got into the discussion of death estate computation, which was an easier task. Residence NRV was the highlight of that explanation. With plenty of questions we have done, application 8 and the 9 to understand how to tax the death estate. While the chapter 1 was about to finish, we have done 2 little discussions, the transfer of unused NRV and the transfer of unused residence NRV. So what was there in it? It was required to keep a knowledge of before getting into the further aspects. Although, if you ask me, that totally is a revision of what you people have done in the past in taxation courses. Then we got into this further aspects, advanced aspects, complex aspects, which you obviously never have studied in the past. And quite a bit of a work we have done onto it the last week. No, I won't say quite a bit of a work, basic work. Main work we have to do today, as there are 3 reliefs coming to our way, and we will be spending a lot of time on those. Those reliefs are not so insignificant that we may finish it off in 1 next hour. We'll probably spending the more of the time of the course of today completing those 3 reliefs: business property relief, agricultural property relief, and quick succession relief. What we have done the last week from this chapter was more about on the evaluation of quoted, unquoted shares, unit trust, related property valuations. It all started off by valuing the quoted shares, those when those are quoted cumulative dividend, cumulative interest. And when those are quoted, excluding interest, excluding dividend. This is that valuation process we understood the last week. Unquoted shares, I told you, the question provides us with the value of it because practically speaking, the value of unquoted shares is agreed with share valuation division of HMRC. While unit trust takes the lowest of the two prices. Then came the related property valuation. The idea was first of all define what is related property. A property is said to be as related to me if it has been owned by, first of all, it must be a similar kind of property that I own. I'm a donor. So the type of property I own, similar kind of the property must have been owned by my spouse or the exempt body to whom I have transferred that asset to previously. Exempt body will be a charity qualified or a political party. The types of the assets, those they come in unquoted shares and securities, adjacent plots of land, some jewelries, paintings, chattels, I mean to say, will come in. The most common scenario in your exam in regards to related property will be the one that's been owned by the donor of a spouse of a donor, and in relation to unquoted shares and securities. There was a formula we understood, and based on to that, two questions will go. Remember that question of shares and that question of percentage of hold. One question was left. We will do it today to start the course actually. This is what we have done the last week on this chapter, which I can tell you is the basic of this chapter. Although it's all advanced knowledge, this valuation thing, you do not do it in basic taxation course. It's all applicable to advanced taxation, but for this chapter, it was a basic knowledge to start with. Mainly, we have to spend time onto this in a while. Reliefs, like capital gains tax reliefs, we have done in the past 9 of them. Such a massive topic it was. Rollover relief, gift relief, we have incorporation relief, investor relief, business asset disposal relief, there was principal private residence relief, there was letting relief, there was EIS reinvestment relief, there was SEIS reinvestment, there were 9 of them. And every relief, you can remember, had taken a lot of time. Same way, except double taxation relief, we will not do it. This is in relation to overseas aspects. Overseas aspects, we will do it at later stage. The 3 of them we have to finish, BPR, APR, and QSR. We'll start it off in a while. We have done another thing from this chapter. Remember a discussion of reduced rate of inheritance tax, 36%. That was all the newish knowledge. But because that knowledge was connected to previous chapter, I came to explain to you that of in advance, this topic, reduced inheritance tax, where the idea was that if the qualifying charity is more than to or equal to that 10% of baseline amount, and there was the way that the baseline amount was computed, then 36% rate instead of 40 will be used in computing the death IHT on death state. And if it is less, then you use the 40%. It was a small explanation that had to be understood. In the continuation of last chapter, I had been able to finish it. It has got nothing to do with the release. But I see one problem in this. I was checking my own explanations because I keep on reviewing my old lectures also. One problem that probably we have made in the computation of baseline was the figure of the baseline was not right. Because when I was explaining to you of the baseline amount, the definition was this: total value of death estate after release, exemptions and NRV, but before charitable legacies and residence NRV. So this was explained. But when this was being applied into that question, a little bit of trouble we have made in taking the wrong value, and this I can correct it so that you won't lose anything on that. It's small little problem, but still I am there to correct it. So first thing that needs to be looking into is the facts of application 14. Application 14, person has died, providing us with family home, quoted shares, cash. He owes this much to tax authorities and leaving the shares to his wife, the family home to his children, and 71,000 to a charity, which is an exempt legacy, charitable legacy. Alex had made one life transfer back in 2017. So when I started off solving this question, we started off solving this question by the way of the way normally we finalize the value in death estate. So this way the death estate was finalized. All of the assets being put together, because we know that everything in the topic of inheritance tax is chargeable. So I had been able to take the house, shares, cash, all three figures being put together with the deduction of taxes payable. I had been able to calculate the chargeable amount. And then the exempt legacies. Two exempt legacies we have in this question, the one being given to wife, the other being given to charity. So what has been given to wife? Shares. So 135 was exemption. 71,000 was exemption. I have been able to subtract. So there's no wrong in this. I'm revising it so that we get back into the same flow to learn the little mistakes we have done. All fine. We have been able to calculate this chargeable amount. Very next to that, we come to compute the residence NRV. Residence NRV to apply to conditions to satisfy. First of all, he must have owned a house, which he owns. To whom the house has been passed on to? Children, direct descendants. So residence NRV, definitely 1 is to 5. Lower of two things, the value of house and 175. Definitely 175 was less than 2x, so I have been able to write this. This is even fine, no problem with that. Then came the normal NRV. Normal NRV is all about looking back into last 7 years to see any transfer has ever absorbed the band. So we see this transfer in the last 7 years have been exhausting the band. But to find the chargeable amount of this transfer, one has to think of deducting those typical exemptions. So this 307,000 has been worked by deducting the exemptions from. That was done on the previous page. And this was the chargeable amount of this pet after deducting the exemptions of past 2 tax years. Taxable amount 36. So there is absolutely no problem in this we have made in the entire process. The problem we have made is into the computation of baseline amount, based on to which we have to decide to apply 40% rate or 36. So the next page was the page of the computation of baseline amount. This will require to have a bit of a revision in it. Baseline amount is the chargeable amount of estate after deducting all the exemptions, reliefs, and NRV. But before deducting the residence NRV and charitable legacy. So we have been able to add back the charitable legacies into it. That's fine. Look into it. This is the chargeable amount of estate, a value from which the NRV has not yet been deducted. See, this is the problem we have made. This figure has not yet been deducted from, because the baseline amount is total value of estate after deducting any sort of reliefs. These reliefs are, in fact, we have to study today. BPR, APR, because it's the same chapter. And this question is not testing those reliefs, but to explain that amount, reliefs, any sort of exemptions, means interspouse exemptions, means charitable legacies, and NRV. This is where we have made the problem. The NRV was not being taken out because it has to be after that. So this amount is the amount that's after any sort of relief and exempt legacies. This is fine. The only thing that's not been deducted out of it is the NRV. The available NRV, whatever is available, that's 18,000. This is where I was observing a bit of a mistake we have made, and I am here to correct so that ultimately you won't lose anything out of it. So when I came to calculate the baseline amount, I did use this value. I should have rather used this value, taxable amount. So I'm going to replace this amount with the taxable amount to revise the calculation. Taxable amount. Obviously, I will be able to upload the revised PDF of code work today. Taxable amount. Taxable amount is 23300. Okay. 233 33300. This is the taxable amount. Now, this taxable amount, let's see, is after deducting all the exemptions and NRV, but it should not be having a deduction of two things from it. Charitable legacy should have not been deducted and residence NRV. So these two figures I will be able to add back, as this is the figure we have, which is after subtracting the charitable legacies, also the residence NRV. So I will have to add now the two things. Charitable legacies have already been added. What needs to be further added is residence NRV, which is 175,000. So this is where whatever the value we will get, we will be able to take a 10% of it, plus 71,000, plus 175,000. It's 479,300. The 10% of that will be 479,300, 47930. And if I try to compare the charitable donations, charitable legacies to that 10% of the baseline, it still is more than so. So effectively, we will still have to calculate the 36% up there, but the definition of baseline cannot go wrong. You must have to be so much perfect about which a little bit of mistake was made in, and then later when I came to review my own code work, I found that mistake was in the live course. When there are too many things going on, sometimes I also can miss out a point or two, which I've thought of that, okay, it's fine in the continuation of course, but later I found this problem into it. I'm revising. Baseline is the amount in which you have to make sure to take total value of death estate after deducting the three items, reliefs, exemptions, and NRV, but before deducting the two items, charitable legacies and residence NRV. So the value of death estate that was here is the taxable amount, but this taxable amount is after deducting a lot of things. Almost everything out of that has been deducted. What should have not been deducted? The two items, which I have been able to add back. The first one, the residence NRV. The second one, charitable legacy. When these two are added back, this turns out to be the right baseline amount, and the 10% of that is about 47930. Well, the legacies are still more than to it. 36% rate we have to apply. Okay, correction is made. And if you come into a course by the revision of this, obviously you are in a better state to revise this with me. Else, no matter how many times I revise this thing for you, you still will not be able to pick it up, because in the matter of 6 days time, you forget it, what we do in the past 6 days ago. It is the case that you realize every time, and still if you do not do any efforts for it, you do not take any measures for it, you just start next week, go to work, come back home Monday, Tuesday, Thursday, Friday, Saturday, and the next weekend comes and you just come into a course. This way by you're just killing the life of this course. 2 months have already gone, 2 months are still left. And these 2 months, coming months, are the months in which you will expect to see me putting additional classes also. I will be sharing you the plan soon. Some topics I'll be able to provide you in a recorded manner. So even you have not developed the habit of studying, making a timetable in the past 2 months where things have been too easy, once a week a course on Sunday, how will you be able to coop up in the next 2 months? Do you have any sort of planning going on beside that? You are ATX exam coming in December and you have to now start getting it up, since the September exams have also been finished the recent week. And now my target for the December exam is ATX, and I am just about 2 months away of the completion of course, the revision course, and then the exam. So have I really started thinking of it, or I just have been taking a course casually, coming into a live session? There's a lot more to remember. I have already insisted you on, especially in advanced taxation. I never say these things to other subjects because I know the length of the course manageable to study when you even decide to study it at later stage. But advanced taxation, once you lose the whole momentum, you never will be having a chance of picking it up. No matter how much number of hours you are going to study in the month of November, never you will be able to catch up the pace of the course with in comparison to those they have been taking the live sessions every time, and then at their own part they have been continuously revising. Okay, that was this discussion in further aspects. Reduced IHT on the substantial legacies to a charity when charitable legacies are more than equals to the 10% of the baseline amount, but if it is less, we go by use the 40%. Finding the baseline amount is very important because you decide it based on to that amount, and if that amount is not right, then your decision will be based upon the wrong information. Fine. And then we got into the discussion of the, like I told you, quoted shares valuation when those are cumulative and not cumulative. This is that explanation of latent property valuation, A over A plus B, value of shares before transfer of one share, value of shares after. And this was on the latent property valuation, but within which they have been having that interest, percentage of interest. There we had the objects, shares. There we had the percentage of interest, because when we understood this topic, we have seen both the possibilities. See, when you are having the assets like shares, and when you are having the shares. So we've seen it from both the sides, and both applications we have done. Let's do the one more on it, which will be a connection to the last week's explanation before we eventually start off with the release. Mike gave 6,000 shares in Plus Limited, an unquoted company. 6,000 shares being gifted out. How many does he own actually? The company share capital immediately before the transfer comprised of 20,000 ordinary shares. Mike himself owns 8,000. Before, in a picture before, Mike owns the 8,000. So 8,000 must have been the 40% interest. 8,000 out of 20 is the 40% interest. His wife, now wife's shares are related property. Donor, spouse. See, two of those relations can be called to be as related. This is where you need to remember the definition of related property. Brother's property is not related, sister's property is not related, father's property is not related, spouse property is related, or exempt body property is related, provided that exempt body is the one to whom I have transferred that asset to previously. In that case, if the exempt body today owns that asset, will be a related asset to me. I take you back to that page to once again show to all of you what makes the property to say a related one. If it is owned by the spouse of donor or exempt body, which can be a charity or a qualifying party as a result of gift from that person. In the past, I personally have gifted that asset to that body, and today that body owns that property. In that case, the property is said to be related. So don't you think before practicing a question of this kind, you should be aware of the definition of related property. So this is related, and with the combined hold has to be 50%. 2,000 out of 20 has to be 10%. While brother, sister, father here, not interested, not related. The agreed values they have provided at different percentages, what value we have to take, they have provided. They want us to calculate the transfer value. Related property valuation rules immediately will apply, and the question will provide us with this related person, wife is involved, exempt body is involved. I told you most common scenarios in exams where the related property valuation rules are tested is the body, the asset being owned by the spouse of the donor, which in this case is happening, which in the previous case was also happening. See, his wife, Jonathan's wife, Jessica. Also in that question, the Sarah and her husband. So most commonly, donors property will be in related property into our questions. But that does not mean you should not remember the other way. The other way is exempt bonding. If owns the property to whom that you have transferred that asset to previously, that is also a related property. And the related property valuation rules are applicable to unquoted shares and securities, adjacent plots of lands, and some chattels or these sorts of paintings, pictures, and all. So in that question, we had the number of chairs, and chair, you know, that is a chattel. These are the unquoted shares, and unquoted shares are the related property valuation rules. We are also going to see unquoted shares into it. Let's go to apply that knowledge. So how many shares been transferred now? 6,000. Let's go and make a picture of this kind. One more before and after, because this before and after picture make us all analyze by how far the percentage had been there before and after. This is application number 5. Good if we had worked this question the last week itself, but I guess the time was over and we could not really do it. But I'm doing my best to revise all of the last week's explanation before attempting it. So 8,000 shares is what he owns personally, and his wife owns 2,000. Names are Mike and his wife. 10,000 is the total hold of both the persons into that company. Before 6,000 shares transfer, after 6,000 shares transfer, now he will be having an ownership of 2,000 shares, while the wife will still have 2,000. She has not made a transfer. So the number of shares collectively that now they own is 4,000. So at 10,000, by how far they will be having an interest in the company? 50%. Because total share capital is 20,000. And this will be 20% after. We will be able to pick the relevant values. At 50% interest, the value is £7. At 20% interest, the value is £4. So I also can write it that the value of each share is £7, which in this case has become £4. Once we have made the analysis, and now we can draw that picture of value before and after to really get our answer. So value before the transfer of 6,000 shares. Value before the transfer of 6,000 shares. And value after the transfer of 6,000 shares. 8,000 shares is what he owns before, and the value is £7. 2,000 shares he will be owning after, and the value is £4. So this is going to be 56,000. This is going to be 8,000. The answer in the end will turn out to be 48,000. Probably we have taken about 10 minutes in solving it. You should have done this question the last week, but I guess the last week the time was already over. We have left the course 10-20 minutes after. So I thought of deferring it to this week. We've done it. Not actually a topic of today. It's all the last week's explanation that I have been able to spend 30 minutes of the course of today to develop that momentum and flow. I have been able to spend on revising, showing to all of you of what this topic is all about, what we have done the past weeks. All it had taken me about 30 minutes to finally say that I'm starting the course of today. And starting the course of today with the first relief called as BPR, Business Property Relief. So important. I mean, the reliefs of this chapter, when you are tested on inheritance tax, the most important area at advanced taxation, you will be testing on the reliefs of inheritance tax. But obviously, you cannot apply the reliefs without keeping all the knowledge of the inheritance tax that we have understood. Over and above to the reliefs we are now getting into. Business property relief is the first one. When you will understand it, you will be able to understand the APR so easily because both are pretty much similar. This is the main one. If you're done with this, to complete that up will become easier. While QSR is something else, and we will do it in the last. This will be worked later on in the overseas aspects chapter, not today. Double taxation relief is the relief which is applicable to a scenario where we have an overseas properties. BPR, basic theme, let me explain to you before we take ourselves back to the lecture notes. Business property relief. So what this relief is all about, suppose you make a transfer, and this is how the way you start off with the transfer value. Remember always, very next to it, there is usually a deduction of annual exemption. Remember, suppose if this tax year is 21-22, so you come down to subtract the exemption of 21-22 and then 20-21. So annual exemption reduces the value of transfer by 3,000. But these exemptions are very small. Since the value of transfer can be in millions, the value of transfer can be in hundreds, thousand. These exemptions are very small and regular. Business property relief significantly reduces the value of transfer. Significantly means at times 100%, can be 50%, and to be deducted always before deducting the annual exemption. So if I have to incorporate the business property relief, this will be incorporated right before incorporating the annual exemption. This is the placement of it. I can highlight in some different color. This is the placement of it. Now, what I was telling you, it's proved. This is the transfer of value thing. We have a knowledge of that, haven't we? And we just need to insert that PPR in it somewhere, and that somewhere is this place. So imagine you do not know how to find this basic value of transfer, means you are not aware of those marriage exemptions, annual exemptions, diminution value concept, related property valuation rules. How will you be able to insert the BPR in it? Because you do not know actually the way that lifetime transfer is valued. So it's the same topic, BPR will just be incorporated with it somewhere. That somewhere I have told you. Very next to the value of transfer, it will be deducted. Before deducting any exemption, may it be an annual exemption, marriage exemption, or any exemption, this will be deducted from here. And significantly it reduces because this can take the relief, the value of gift down by 100%. In some situations, it can take the value facet down by 50%. Means this value will be reduced by 100% in some cases, 50% in some cases. So it significantly reduces the value of transfer in comparison to annual exemption. This is the significant relief. But to avail this, certain conditions one must have satisfied, and these conditions are the ones that I can talk about. Only applies when the conditions are satisfied. The first condition is the property must have been a relevant business property. It must be a relevant business property. And secondly, it must have been qualifying period of must have been owned. It must have been owned. Must have been owned for a qualifying period, and this is what I can explain. Qualifying period is, so I have not revealed so far what do I mean to say when I say relevant property. What do I mean to say when I say qualifying period? I will expand my explanation towards, I will tell you, okay, 2 years, 3 years, 5 years. I can tell you this is the list of assets which is relevant. I have been able to broadly tell you that two conditions it has to satisfy. The first one, it must have been a business property. It must have been owned for a qualifying period of time. So what is the qualifying period of time? What is a relevant property? Let's go to have a look. Two conditions needs to be satisfied. The property that's been transferred must have been a relevant business property. Secondly, must have been over a qualifying period of time. So let's get into the first debate. What makes the property to say relevant for this relief? There are 4 of them, and I have been able to prepare a chart which I can show to all of you by taking you back to the lecture notes. There are 4 of them: unquoted shares and securities, quoted shares and securities. If you have transferred the entire business, means you are a sole trader and you have a business which you own it as a sole owner. If you make a transfer of that, or if you have an interest in partnership, you sell your interest into your partnership business, or you have just a plant, building, land or property that you own in a partnership business in which you are a partner, you make a transfer of. Or you make a transfer of property, plant and equipment of a company in which you have a hold of more than 50%. So I have got all those conditions into my mind. And this is where I always advise you to keep on reading it. Remembering the conditions, the rules and all is not really a concept learning task. It's rather reading. You read it out for the number of times you start remembering. So before I have to show to you, I have been able to call 4 things I can finally show to you. I can once again revise. First of all, if I make a transfer of my sole trader business or my interest in partnership business, this is a relevant business property. Secondly, if I make a transfer of unquoted shares and securities. Thirdly, if I make a transfer of quoted shares and securities. And fourthly, just make a transfer of plant, of anything, plant, land, building, machine, of my partnership business in which I am a partner, or from a company in which I have a hold of more than 50%. These 4. And even within this, one has to respect that hold shape, that the hold has to be more than 50%. For quoted shares, the hold has to be more than 50%. For unquoted shares, the holding does not really matter. They're too much to remember. It's not one-dimensional. There are a lot of things you have to also get down further into the bottom and remember. Finally, let me reveal that chart. This is that chart that I was talking about. There are 4 of those relevant business properties. I even can number them off. 1, 2, 3, and 4. At least things are written in such a manner that you will not find yourself somewhere in lost situation, as there's a nice table, organized table within which everything is written to the point. Okay, first time, a transfer of an unincorporated business. Now, business can either be a partnership business or a sole trader business. That is what I was talking about. That if I make a transfer of whole business of sole trader, or if I make a transfer of my partnership interest, 100% DPR is available. 100%. Okay. If I make a transfer of unquoted shares and securities, for shares, the hold does not really matter. But for securities, has to be more than 50%. Regardless of the interest in company, I may have a hold of 20, 25, 30, 35, maybe even 90%. Does not really matter. But for the securities, I have to have a hold of more than 50%. So you cannot be just on one dimension. You have to sit further into it and see, okay, even for the shares and securities, if I'm on to unquoted side, I have to respect that percentage thing for the securities, not for the shares. And then 100% DPR is to be applied. And for quoted shares, share securities, both the hold has to be more than. For quoted shares, you can be on one place that, okay, for quoted shares and securities, the hold has to be more than 50%. May I hold the shares, may I hold the securities. But for quoted shares, the DPR will only be 50%. And then the last thing, just a transfer of one land property means just you have disposed one machinery, just transferred one machinery, one plant, one building from the business in which you are a partner, donor is a partner, or if it is being transferred from a company, you have to have a hold in that company by more than 50%. The BPR will be applied at 50%. So it is available into 4 relevant business properties. And this 4 thing has to be keep on remembering. Whenever you are sitting even alone or doing something else, try to keep on revising that lesson to your mind. I share you my experience, I do it the same way. And I feel so disturbed if I cannot remember the one. I keep on thinking of that, but I should have to revise all 4 in one go, even if I'm driving, suppose, and this suddenly comes to my mind. So I give it myself a challenge. Let me revise those 4 items. So I try to remember that all of those 4 items into my mind. And if I don't find one of the thing that's not been revised, I feel so uncomfortable about it. And this makes me more anxious to come and look back once again in, so that I should be keeping the list of all 4 in my mind. You should be also developing that habit. You have to sound so crazy talking to yourself while you're in your room, that let me try and take 1 minute or 2 minutes to recall that list. If I'm done with, fine. If I'm not done with, 1 or 2 items have not been remembered, just open the file once again and have a look. Just don't let it go like this. This kind of attitude will not help you, especially in the course of advanced taxation. There are too many things to memorize. Remember, there is no concept in it. Literally, are we learning something over here? Is there any theory that one has to have the whole conceptual idea of reasoning of? Just a rule-based thing. Chart is there, and you have to look into that chart several odd times for you to remember. All of the types of property have got one thing common in: must have been a trading company and business. It must have been a trading business, not an investment business. This is the common thing in all the cases one has to respect. Investment means a business who is involved in dealing in shares and securities, making and borrowing, like financial institutions, who has been having the properties, those are being kept for the purpose of letting. That's investment business, real estate business. So the relief will not be applied to those businesses, those they have the investment nature of business. Trading business it has to. This is one common thing one has to do. So that ends the first condition of it, that it must have been a relevant business property. That's the first condition. I have been able to at least spend quality amount of time onto it. And mind you, to determine that control, you should not be forgetting related property holdings will also be applied in order to determine the control. And there you should be remembering what is related property valuation. I've just done that even before starting the course today. 3 questions we have done onto that with that whole explanation. So to determine the control, we might end up applying the same related property valuation rules to determine the control. That's the condition 1. And this application is just onto condition 1. Before we get into the condition number 2, this one, qualifying period, I have not yet explained. We have an application to work just onto that condition 1. So realize the importance of this condition. John owns the following assets. Fine. State whether the John's assets qualify as BPR. So we just have to answer if these are the relevant business properties or not by saying yes and no to it. And then we also have to give it the reason of why not. 42% of ordinary shares of a PLC are quoted company. Now, when the shares are quoted, the hold has to be more than 50%, which in this case is been a miss. So no BPR will be applied. This is not a relevant business property for the purpose of BPR. As for the quoted shares, the hold has to be more than 50%. Although this company is a trading company, but the percentage of interest is what based on to that we say no BPR. Next one, 19% of ordinary shares and unquoted. Yeah, for unquoted shares in securities, the holding does not really matter. And for unquoted shares, the 100% BPR is one has to apply. Whatever I am doing it right now, it's all from this chart. It's all from this chart. From unquoted shares and securities, the holding thing does not really a problem. 100% BPR will be applied. Third one, a factory owned personally by a John, but used into a partnership. He has to be a partner of that partnership, but he is not. No BPR. Remember the last thing? He might have made the transfer of land, plant, building of a partnership business. Donor has to be a partner, and he is not a partner. So much attention is required on each of a word, and ultimately I decide no BPR because of the reason of not a partner. 32% of ordinary shares of the GPLC are quoted company. So for quoted company, remember the hold has to be more than 50%, which I do not see is being satisfied over. And John's wife also owns 6. Oh, John's wife. Now this is where they probably have required us to apply related property valuation. And I did explain this to you that while determining the control, you have to also apply related property. So your wife's shares must have been the related property. So by how far the wife will have an ownership of it? 16. So even if I combine 16 into 32, that's not going to touch 50%. That's only about 48%. Who owns the other 59%? Daughter. But that I cannot take. Daughter's share is not a related property. So by combining the 16 into 32, still short of 50, no BPR will be applied. So there I also have been able to demonstrate that how you can make the use of related property valuations even within the BPR. 16 plus 32, 48. Less than 250, no relief. Yeah, if these shares were unquoted, definitely the BPR would have been applied at 100%, as in the second scenario. How extensively the explanation of this relief has been planned, you all can sense. Finally, this will allow us to go into the second condition. Well, the second condition is to have the qualifying period of ownership, and to tell you, it's 2 years. It's written on the way. The relevant business property must have been owned for a period of 2 years, immediately preceding the transfer. Minimum means 2 years or more, can be 4, 5, 10, 20 years. It should not be less than 2 years. 2 years or more, that is the second condition. No further talk on it. Because there we had the list to look at. But there we only have to remember that 2-year thing. That's it. Nothing more to that. The asset means the business if he makes the transfer of. The partnership interest he makes the transfer of. Shares if he makes the transfer of must have been having an ownership over to those by at least 2 years before making the transfer. At least means 2 years or more than 2 years. Interestingly, this application 7 will bring us to another exception. Exception is that what if the 2-year qualifying period has not been satisfied? The BPR is not available, but BPR still be applied in the case where the asset was inherited from a spouse. And the combined period must have to be considered. See Mr. A and Mr. A's wife. Mr. A makes the transfer of the asset to Mr. A's wife. And then Mr. A's wife has been able to make a transfer of that asset to someone. So we will not just see the number of months and the years the wife has owned an asset before she makes the transfer asset to someone. We will also be able to combine his husband qualifying period also. Collectively, we will be able to see the couple's total ownership for the BPR to apply. That's the last line, that if it is inherited on the death of spouse, the couple's combined ownership must be taken into account. that discussion does not apply to any other relationship except in a spouse. For otherwise, the 2-year period must have to be satisfied. But in the case the couple is involved, then we will have to combine the couple's total ownership over to it. If one spouse of the couple does not own a house for the 2 years, then we will be able to combine it with another spouse's ownership over to it for a BPR to apply. And this will demonstrate in application number 7. Let's go to attempt. This has exactly been demonstrated in application 7. Don't you feel worry if you are not getting the right idea about what I've just said. Pine inherited an unincorporated business from his wife. So, husband and wife are involved, and the wife is the first party in it who has transferred her business to husband Pine. So, I will write the wife on the first over here, who makes the transfer of the business transfer. What was the day the business was transferred by wife to Pine? On 1st of March 2020. This has been done on 1st of March 2020. But dates are very much important for us to notice, because ultimately from this application we are trying to find the number of years of ownership. So how come we don't miss that? We miss out the dates. Pine died on September 2021. Okay, so the death day of the Pine is, he has died on which date? 30th of September 2021. So after the business was transferred to Pine, whose business is it? Pine's business. And he has died in 21. So for how long he will be owning that business after the business was transferred to him? Let's count the number of months involved. It's going to be 1st of March 20 to 1st of March 2021. And then March, April, May, June, July, August, September, 7 months. To add into 12, 19 months. There is the 19 months of ownership of the Pine over to this business. And it is a relevant business property. Why? Because it's the whole sole trader business, and the sole trader business, the transfer of that itself is the very first relevant business property in fact we have seen. So this is already satisfied. We are only focusing on the period of ownership, which is looking to me a bit of a short of 24 months. Can you see? So Pine has a relevant business property, but he has only owned that out for the period of 19 months. It means on the death of the Pine, the BPR will not be available. But this is where we have learned an exception. We have to see for how long this business has been owned previously by his wife. And that they say 1 year. Pine's wife had owned the property for 1 year. This business previously has been owned by his wife, owned for 1 year previously. Now, this is what I will be able to combine it into that 19 months thing for the Pine to become eligible for BPR. I will take the 12 months from here. I will take the 19 months from here. The total will turn out to be what? 31 months, which is definitely more than to that 2-year rule. Hence, the Pine will become eligible to apply BPR. The couple is involved, combined period of ownership over to that business will have to be considered. The combined period is 1 year of wife, 19 months of Pine, total is 31. This exception you cannot apply into any other situation. In any other situation, one has to definitely respect that 24 months ownership I mean, if these two were two unconnected parties, this is a random lady transferring that business to random guy, I would have definitely not done this. I would have rather focused on to 19 months for me to say that the pine is not eligible for BPR, but because they are the spouses of the married couple. That way, it will be true. Explain this to you. Probably when you read the text sometime, you don't get, but when you have an application which properly involves the dates and all, then you get the proper sense of it. So we are still investing time on two things right now. These two things, so extensive. Ultimately, once the conditions are satisfied, I told you that it needs to be deducted next to the transfer of value before the deduction of any sort of exemption, annual exemption, marriage exemption, or any other exemption. At 100 or 50, that you already have seen what type of property will enjoy 100%, which type of property will enjoy 50%. Good going so far. Anything that's been written that not been touched upon, or am I going too quickly on it? What's next? Minimum period of hold, which we know that is 2 years, but in some situations we can have an exception. Exception means even if the 2-year condition is not satisfied, the BPR will still be applied. Other than spouse case. See, other than spouse case, if the 2-year period is not satisfied, then still we will be having a chance of using the BPR as an exception. And there are 2 exceptions. As you can see, let's go to spend time on each of the exception one by one. 2 key situations where the 2-year qualifying period is not satisfied. The BPR still is available. And in this situation, I'm not involving a spouse in it. It can be applicable to anyone who makes the transfer to anyone. The period of 2 years, if not being satisfied, still the BPR is applied. And these 2 situations need to be talked about. What we can do, we can take application 8, not just for the purpose of solving, but for the purpose of understanding this replacement property. What do I mean to say when I say replacement property? Well, it can happen sometimes. Today I make a transfer of one relevant business property to someone. To replace another business property with. So it's like a replacement. One of the relevant business property replacing another one. So in that case, we will have to see the combined ownership of 2 relevant business properties. The one that I have replaced, the ownership over to it, and the one that I have brought the new one in, the ownership of needs to be combined. Must be having an ownership over to it by 2 out of 5 last years. Combined ownership over to 2 those relevant business properties must have to be considered. So I have one relevant business property which I make a transfer so that I can bring a new one other than that. So this time it's a replacement of relevant business property to another relevant business property. So I will have to check the combined ownership over to both. The number of months I had been holding the previous relevant business property and the number of ownership months I will be holding it, the new one. See, BPR is still available, but the relevant business property has not been held for the period of 2 years. Why? Because I have been able to replace it with another relevant business property. So, combined period of ownership one has to see, and that still uses the same 2-year thing out of 5 last years. This is exactly in application 8, you will be able to see me demonstrate. Probably the sense you have understood. It's like the same case we have done before, that wife's ownership, husband's ownership, collectively we have seen. So there we will see the ownership over to the previous relevant business property and ownership over to the new one that's been replaced. Combined has to be 2 out of 5 years. BPR is given by taking the lower of 2 property values. means you will be able to apply 100% to the which value? Lower of two, which, because I have got two properties, the one that I have just transferred, the one that I have just acquired. So I will see the value of the two of the properties, whichever is lower, I will be applying 100% rate of BPR to it or 50% rate to it. This is exactly in application 8, you will be able to demonstrate. Calculate the gross chargeable amount of the Zim's lifetime gift to her sister. On 31st of October 2020, unquoted trading company. So the matter is a matter of unquoted shares and it is a trading company. So trading company, unquoted shares investment is a qualifying relevant business property. And on that, the BPR is 100%. Means in this question, whatever the value to which I will apply the BPR to, the rate will be 100% since the unquoted shares are involved. And for unquoted shares, the holding thing does not really matter. You may have a hold of 10, 20, 30, 40, 80, regardless of the fact. J Limited was taken over by M Limited. Let's try to draw a picture to see who is taking over whom. J Limited was taken over by M Limited. J Limited was taken over by M Limited. So M Limited is the one taking it over. Now, this also requires you to remember the topic when I have done it in the past in capital gains, takeovers and reorganizations, because this is something that you can relate what happens on the day the takeover takes place. M Limited is the one who is going to acquire N Limited, J Limited. So this company is going to acquire J Limited. What day is the day this has been acquired? The day is 31st of October 2020. Okay, that's the first line. I guess nothing is written more than that. An unquoted company. Zim had owned the ordinary shares in Zim Limited. So Zim, I will assume myself as Zim in it, an individual, any person, Zim, Alex, Melissa, whatever. So this is Zim, who has been having a hold of having an interest, owned the shares in J Limited for 3 years before the takeover. Zim is having an interest. Acquired 3 years ago. The consideration on the takeover consisted of the ordinary shares in M Limited. Now, this is what I have explained that in the past, that Zim has a control over to that company, or simply an interest into that company. May have been a controlling interest, not a controlling interest. That's not the debate, because for unquoted shares, the control does not need to be there necessarily. Zim is having an interest in J Limited, and his company has been acquired by someone. So that company definitely will come to pay a price to Zim. That price is usually a share in a new company, or a cash, or maybe a combination of both, which in this case obviously is going to be the shares. This is my company, someone has come to acquire, someone definitely will pay me a price. That price is what? On September, the consideration on the takeover consisted of shares in N Limited. So now the Zim will be having the shares in M Limited. He will be having an interest in M Limited. He'll become a shareholder of M Limited and have lost the ownership in J by holding whatever the number of shares. They have not told us the quantity. Zim will become a shareholder of M Limited. On September 30th, Zim gifted her shares in Limited to sister. Then This is a story after to it, so I will look into it. The shares in M Limited were worth 170,000. Her shares in J Limited had worth 120,000 on this date. Now, on the takeover, the market value of these shares they have given 120,000. Yeah, this is the market value of the shares in J Limited. So I have been able to label it. What happened next? After Zim now have become the shareholder of M Limited, this I can write it in second picture. This is Zim now having an interest in M Limited. Zim owns the shares in M Limited, no matter what shares. And he makes the transfer of these shares to whom? To her sister. Transfer to sister. What day was that being transferred? September 2021. 30th of September 2021, this has been transferred to the sister. And the market value of shares on that day, they have given 170,000. Market value of shares on that day is 170,000. So I have been able to probably label all the things that I have, and I do not need to look any further back into question. Do you understand the situation? If I assume myself as Zim in it, I had been an actual interest. My actual interest was in this company J Limited, which I have acquired 3 years ago. First of all, is my interest in J Limited is a relevant business property? Yes. Why? Because my investment into J Limited is unquoted shares and securities. Regardless of the fact I hold the company by 50, 60, 80, 90, 100. And I have acquired those shares 3 years ago. So the interest of Zim in J Limited is eligible for BPR. Is eligible for BPR since qualifying period of 2 years being satisfied. Also, these are the unquoted shares and securities. That's the first relevant business property in this question, who has even been held for the period of more than 2 years. Okay. On the day the takeover takes place, this has been replaced with another relevant property, because the shares in M Limited is going to be another relevant business property. Why? Because once again, these shares are unquoted. These shares are unquoted. So one of the relevant business property is replacing another. He had been having the shares in J Limited, which now has been replaced with the shares in M Limited. And both the investments are the relevant business properties for the purpose of BPR, unquoted shares. And these companies, both of these companies are trading companies. You see, I'm checking everything absolutely. Both of these companies are trading companies, unquoted. So the investment into that company is a relevant business property. This was the old one, this is the new one, and the new one has replaced the old one. And there we will have to count the collective ownership of mine over to these two. This ownership, they have told that on this the ownership was 3 years, but we have yet to identify the Zim's ownership into M Limited for how long. So that should run from the date of takeover to the day of transfer. How many months we see in between? Because this is the day these shares have been acquired. So we have to see the ownership of these shares from the day of takeover to the day of transfer of these shares to sister. How many shares we see in number of months we see in it? It's going to be about October 21 Oh, not even October. It's going to be some months. Let me count. November, December, Jan, Feb, March, April, May, June, July, August, September. 11 months. 11 months of ownership. I have over to the shares in M Limited, which obviously, if I look into isolation, not eligible for BPR. Not eligible for BPR. So I make a transfer of shares to my sister. My shares are unquoted of a trading company. Fine, it's a relevant business property. But I am not owning those shares for a period of 2 years or more. But because this relevant business property has been a replacement of another one in the past, so I will be able to use collective combined ownership of the previous one, adding it into this one for me to say this one will become eligible for BPR. What is the combined ownership over to two of those relevant business properties? 3 years, 11 months. That takes the whole total up to definitely 47 months. Therefore, the transfer of shares to sister will become an eligible thing for BPR relief. Obviously at 100%. The lower of two. I also can do a figure work over here. Combined, let me conclude. The combined ownership is 3 or 36 months plus 11 has to be 47 months, which is more than to that 24 months mark. And therefore, this transfer of shares to sister, which is a relevant business property, also have satisfied the criteria of 24 months more hold. Makes me to apply BPR, which I really can apply. Transfer of value. The shares been transferred to sister have a value of 170,000. And then I will be able to apply BPR very next to it. 100%. But which value should I multiply this 100%? I told you the BPR will be calculated by taking the lower of two property values. So the previous property value was 120,000. This property value is 170. So the lower of two has to be 120,000. This how the way the BPR will reduce significantly the value of transfer. Lower of two I have used the values of two properties. And then followed by the annual exemption. Was it a wedding present? No, it's just a normal thing. So I will be using the annual exemption for tax year 21-22 on the first and 2021 on the next to formally conclude, because this is what they have wanted us to calculate, chargeable amount of transfer. They do not want us to calculate the inheritance tax. Even if I have to calculate the inheritance tax, I know how to calculate it. Next to it, nil rate band, 325,000 transfers into last 7 years. This is the place the BPR has to fit in. That is a topic of a moment. The rest is just a follow-through process and the exemptions to deduct and all. So let's not forget where we are investing the time right now. We are investing the time on to the exceptions, that what if the business property has not been owned for the period of 2 years in certain scenarios, the PPI is still applied, provided this case you have come across to where the one business property has been a replacement of another one, then you should have to check the combined ownership over to the both. The combined ownership makes me to say this transfer to sister is eligible for BPR. So I have. The BPR is then going to be applied at either at 50 or 100. That totally depends upon the type of properties involved. Unquoted shares attracts 100% BPR. Lower of 2. The value of the previous relevant business property was 120. Sorry, 120,000. And for this one was 170. So I did select the lowest of two. and have applied the BPR 100% to it. Am I covering every possible thing that's been written up there? And a lot of questions being put forward, because once you apply this knowledge into question, you always get a better idea of that over and above to the text written. In the second possible scenario, where the 2-year condition, even if it is not satisfied, still the PPR will be applied. It's called as successive transfer. In this case, the relevant business property was held eligible for BPR at the time it was acquired. So at the time the relevant business property was acquired, it was eligible for BPR, and you have acquired that property either as a result of death or will become chargeable as a result of death. That is successive transfer. At the time the relevant business property was acquired, it was already eligible for BPR. And it was acquired either as a result of death of someone or will become chargeable on the death. Now, there is another thing we are going to get into it. It's called as accepted assets and BPR. There's too much of depth in this topic and it's not really getting finished. What is the idea of accepted asset? Let me first of all give you a little bit of briefing before I can really go back to it today. What is accepted asset? Accepted asset means the assets held for the purpose of investment. Asset held for investment purpose. See, from the start of this topic, we have been emphasizing on that, look, the PPR is applied when you have a business, a trading business. You have an interest in a company, a trading company, unquoted, quoted, whatever. This is from what we had been concentrating hard since the start. So BPR is not applied if your business is of investment kind. That's what in the start is being written. To qualify for BPR, unincorporated business must be a trading business. Or a company in which you have an interest in must have been a trading company. A reputation, a revision. The possibility is there, you have a trading business which owns an investment. Can happen or not. Your business is a trading business, but that business owns one investment asset. So the idea is when you are going to give a BPR, you must have to restrict the BPR only to the other assets, not to the assets held for the purpose of investment. So this time, the business entirely is not an investment business. The business is still a trading business, but that business may own an asset or two of investment kind. Then while applying the BPR, you must have to try and restrict the BPR only to those are held for the purpose of trade, not for the investment purpose. And there is the formula to do it. However, an individual may have an interest in business that owns some investments known as accepted asset. I already have told you the definition of accepted asset. So you may have a trading business that may own some investment assets. So BPR will still be applied, but there will be a little bit of a restriction. That is a proper definition of accepted asset. The one that has not wholly or mainly been used for the purpose of business in the past 2 years and will not in the future be even used. Wholly means 100% or mainly means more of not being used for the purpose of business the past 2 years or will not likely to be used even in future. Examples are also being given for you better and better understanding. Investments into shares and securities. Investments into land and property, those are kept for the purpose of letting. The large cash balances in excess of reasonable requirements. These three assets are the examples of accepted assets. Investments into shares and securities, investments into land and property, which you are keeping for the purpose of letting. large cash balances in excess of business requirements. So while working the BPR, we must have to give the BPR only onto the business assets. No relief will be available for accepted assets. Same way, if you are having the shares in a company, the BPR is only available to the portion of the shares those are attributable to the business side. BPR is available only onto the business asset portion of total assets in business as follows. So there's the formula we will have to work. We'll take the total assets in denominator, business assets in numerator, or you can alternatively take total minus accepted asset. Total minus accepted equals to business assets. Total minus accepted equals to business assets. So business assets will have to be in the numerator. Total assets will have to be in the denominator multiplied by the value of transfer. Whatever the answer we will get, we will be able to apply 100% with this, 50% with this, depending upon what type of relevant business property is it. This application I will come to demonstrate on which the BPR will be finished. Calculate the gross chargeable amount of the Alan's lifetime gift. On the 31st of May 2021, Elan gifted 40,000 shares in estimated unquoted trading company. So the first thing we come to check what type of asset is involved. Unquoted trading company makes me to say a relevant business property. And it is a type of a product audit. The BPR is 100% unquoted shares. 40,000 gifted to her nephew on the occasion of marriage. So this takes us to another exemption, marriage exemption. Annual exemption by anyone, like in the previous question I have applied. On top of that, we also have to respect that marriage exemption, but all to be applied after BPR. So the focus is all on BPR. You should be keeping the basics of the topic with you, that marriage exemption one has to apply, annual exemption one has to apply, but all after applying the BPR. Remember, for a marriage exemption, you have to see the relationship of donor to donee, nephew this time, because 5,000 is from the parent, 2,500 from the grandparent, party to a marriage 2,500, or anyone else 1,000, which in this case is anyone else. So 1,000 marriage exemption is what we will use. See, I remember everything. I can just maneuver around from any part of the topic you take me to. I can just answer you. Marriage exemption is just another expenditure and available into 3 denominations. Depending upon the relationship of donor to donee, one has to take 5,000, 2,500, 1,000. That's from the first chapter of inheritance tax. Do you have this in your Bibles? And if you do not have, then it means I'm proving it to be the right person when I say this to you each time for your regular revisions. And if you're not doing it, you probably are sensing it, that I'm going the wrong way and I have to correct my way as from the tomorrow. And still when the tomorrow comes, we get busy into our work life, family life, and try to defer that whole preparation to the last month, which in this paper of ATX does not work. Coming back to the point, Alan owned the shares since 2008. So shares being owned, the condition of 2 years is also satisfied. 2008 is quite a while back. And on 31st of May, the shares were worth 190,000. This day is the day when the shares are gifted. So they have provided to all of us the transfer of value is 190,000. This is the transfer of value I will start my question with. On that date, S Limited owned an asset. Now they're talking about the assets of the company in which I have a hold in. Total value of assets are 520,000, included an investment property. So this is called as accepted asset. Accepted asset. So although a company is a trading company, but that company owns an exception on which the BPR is not available. The value of that is 60,000. No lifetime transfer we can see in the past also. Simple question. Transfer of value, application 9. Just trying to filter it out. the one investment thing out of the entire trading company. So the transfer value is given as 190,000. I have to make the use of marriage exemption. I have to make the use of annual exemption, like always. I mean, for these things to apply, you do not have to satisfy any criteria. You just have to apply when you are tested. Annual exemption from which tax year? Which tax year? 31st of May, that's 21-22. 21-22, that's 2021. So both the exemptions I can use next to it. Marriage exemption, I already decided to use 1,000. This is where I have to incorporate the BPR at the rate of 100%, but I just cannot apply 100% to this value, since the company that I have an interest in have one of the exception that they own investment property. So I will have to try and filter that out so that I can only apply that BPR to the business side of the company. And the fraction will be used will be the total value of asset minus accepted asset. So this is the total value, 520. And I will be subtracting the accepted asset from and dividing it by total. See, I'm using this fraction right now. Total value of asset, 520,000. Accepted asset, 60,000 divided by total value, 520,000. Multiplied by the transfer of value, the one that we see up there, 190,000. Let me try and take this whole bracket to the next line so that we have a bit of a space down below to adjust this. That's BPR. That's the end of this question. Let the calculator do the rest. 520 minus 60 divided by the 460 that I have got. 460 is in fact the value of business assets. So you alternately can directly take the value of business assets in numerator, business assets divided by total assets. So how to calculate the business assets? Total minus accepted asset. Question can have 2 exceptions, question can have 3 exceptions, or question may not have any exception. This is an exception which I have been able to take it out. This is what I have got, we call it as business assets. Divided by 520, multiplied by 190,000. The rate of the BPR is 100% for surely, since it's unquoted shares, we are dealing with 168,077. That's it. Once again, I can highlight the same thing in green color, as this is the only thing we have been learning it in. The rest is the process that we know always since the start of this inheritance tax topic. Okay, no problem. So that was this explanation. It's finished. BPR withdrawal, something that one has to also respect in the end. When the conditions are not satisfied, then it will be withdrawn. The same conditions, 2-year rule, qualifying period of ownership, it must have been a relevant business property, same conditions. For the lifetime transfers, they say that, okay, you must have to consider the conditions of BPR at the time the lifetime transfer was made, maybe a PET or CLD. And then apply 50 or 100, totally depending upon the nature of transfer. Before deducting any exemption like marriage and annual. There's nothing new in this. If you're wondering that there's something new coming to you, no, nothing is new coming. You know this about. The conditions of BPR are considered at the time of the gift. BPR is given at appropriate rate, 100% or 50%, and must be deducted before deducting any exemption. So aren't we deducting it before deducting the marriage and annual exemption? What's new in it? The conditions of BPR must have to be considered. What sort of conditions? Relevant business property and qualifying period of ownership must be considered at the time of gift. For us to apply BPR, either at 100 or 50%, needs to be deducted before deducting any exemption. What did you read me in that? But that's what we've been doing it. In recent question, we've done that out. We had been applying the BPR at the time the transfer was made. Conditions were checked. It was being owned by 10, 20 years ago, 2008. Back in 2008, it was acquired, and it is a qualifying business property. Why? Because it's unquoted shares of the trading company. So I was checking the conditions at the time the lifetime gift is made. Upon checking the conditions, I did decide that the PPR is applied. Then you apply it either at 100 or 50. That totally depends upon the type of asset is involved. And thirdly, before deducting any exemptions, that is what in the first paragraph is written. What's new in it? We know this about it. Yes. What if the same gift becomes chargeable on death again? Let's not forget the basics of IHT. You remember the donor dies within 7 years of making the transfer becomes taxable on death. And that taper relief comes in, 40% rate of death computations comes in. That's the first chapter of inheritance tax, that if the gifts becoming chargeable on death with that 7 year of death, BPR will be considered once again. It means you will have to come and check the conditions once again. 2-year rule, relevant property, provided they say that the property must still be a relevant business property on the day of death. It must have been still a relevant business property on the day of death and owned by the donee to whom this asset was transferred to previously on the death of donor. Means donee to whom this asset was transferred to in the life still own that asset today upon the death of person. These two conditions, if are satisfied, BPR will be applied on the death inheritance tax computations. Asset is still a relevant business property on the death of person and still being owned by the donee on the death of that person. Yeah, if the two of the conditions are not satisfied, the BPR is withdrawn and will not be available. As simple as that. Good. So what do you see new thing over here? So something that in the end we have to read it, we have been able to. Also, in the case the BPR is withdrawn, and that's a common sense, you need to make it. Also, in the case the BPR is withdrawn, then the original chargeable amount of the asset, including the relief, will become for NRV computation. Suppose this is the value that we've been able to find it out as a chargeable amount for us to charge. See, we have applied the BPR, but suppose if I go to withdraw the BPR, this amount is what? Let me tell you. This amount is 190,000 minus 168,077 minus 1,000 minus 6,000. This figure is 14923. This is the chargeable amount that we have applied once the BPR was applied. But suppose the conditions are no longer satisfied and the BPR is withdrawn, then don't you think I have to come and add back this amount over here to find the original chargeable amount without BPR? That is what the last line says. Because the BPR has to be withdrawn, which originally has deducted, the value of transfer has been dropped by that. But if today the BPR is withdrawn, I will have to come and add back this amount in it to find the value of transfer before BPR for the purpose of NRV computation. That is what the last line says. You don't have to add back these things because that by anyhow one has to apply. It's the BPR that one has to withdraw and reverse the deduction of BPR by adding it back. That's what the last line says, that if the BPR is withdrawn on CLD, the original chargeable amount, including the relief, is used for NRV computation. Including the relief, you will come down to include this back into it. That is the end of this massive relief we've been able to work. APR is easy to learn if you are already good on to the BPR. There we have invested a lot of time. That is what I was telling you, that's a massive thing one has to work, and now you can see why I was saying it. Finally, we've ended ourselves with the BPR. You're quite much being refreshed with the topic of BPR, and we take that moment to get into APR the next minute. Lots of similarities you are expecting to see now. You also will come to see the interaction of APR with BPR, a question in which we will apply both the leaves together. So interaction you only can learn when you know the BPR in the first place. Like we have applied the BPR, we will be able to also insert APR in it, both in one question. That's called as interaction. So when with this will interacted, we will come to understand this. But first of all, we need to understand the basic knowledge of APR. And then we will be able to apply that knowledge to interact it with BPR. Starting it off with agricultural property relief, APR. As the name suggests, agricultural, it means this relief is only restricted to the property of an agricultural kind. Agricultural property relief. So agricultural property relief is very much similar to business property relief. But business property relief is applicable to all the business properties, land, property, plant, and equipment and all, other than exceptions, investment asset. But agricultural property relief is only applicable to the agricultural value of agricultural property. At 100%, the rate is going to be the same. 50% can be there, but I will explain that to you all. But most of the agricultural property relief will be applied at 100%. It's very much similar to BPR, but it only gives on the transfer of agricultural property. Means for this relief to apply, the question will have to have an agricultural property, else it won't be applied. BPR is generally to apply because for BPR to apply, you have to have any plant and machinery, land building. But for APR to apply, the question specifically have to have an agricultural property. The moment you will see that word, you will strike your mind and say that, oh, this one means to apply the APR. And obviously for this one also, the conditions to be satisfied, and the conditions are going to be pretty much the same with few changes into. I'm explaining this topic the same way as above. Condition number 1, relevant agricultural property. Condition number 2, minimum period of ownership. We've learned the BPR the same way. So let's try and spend a bit of a time on understanding what is relevant business property, there relevant agricultural property. And then I will go in down and explain to you of the period of ownership for this. Same way starting, that the two conditions must have to be satisfied. The first one is it must have been a relevant agricultural property. Second one, there has to have a period of qualifying period of ownership. Once the two of the conditions are satisfied, then it must need to be deducted before even BPR. Yeah, see, it's written. Once the conditions of APR is satisfied, then it must need to be deducted even before BPR. Means the placement of this link is going to be before BPR over here. APR will have to come first, the BPR then next, and then followed by the other exemptions, marriage and annual exemptions. Let's get into the list of the relevant agricultural property. They say the agricultural property is an agricultural land and building. The land will take the farm, land and pastures, while the buildings can take farmhouses, pig sheds, barns, milking parlors. In the first, farmland and pastures. In second, buildings. The buildings can take farmhouses, pig sheds, barns, or milking parlors. All of the examples are given there for you to remember. So agricultural property is defined as an agricultural land and building. The land will take farmland and pastures. Buildings will take farmhouses, pig shed, barns, milking parlors. APR is available at 100% on most of the agricultural property, but 50% is available if and only if it has been tenanted and the lease contract was taken before September 95. These two conditions must have to be respected. Because if you are tested onto that, then you should not be using that 100%. Although this 100% to apply is going to be a scenario in most cases. Exceptionally, if it is a tenanted farm, 50%, provided the lease contract was taken up before September 1995. So that's this part. Agricultural property, you should know what makes the agricultural property to be a relevant one for APR. It must have been a farmland or pastures, or in the context of buildings, farmhouses, pig sheds, barns, or milking parlors. 100% on most of the agricultural property, exceptionally when the farm is tenanted, 50% relief will be applied, provided the lease was taken up before the month of September 1995. While the condition 2 is to have a period of minimum ownership, 2 years once again, provided it has been farmed by the owner, 7 years if farmed by the tenant. Clearly, I have been able to write these words in the bold letters. So if it has been farmed by an owner himself, 2 years. And if this has been farmed by a tenant, 7 years. So for BPR, we do not see the ownership in two denominations. For APR, we have to respect it. 2 and 7 years. 2 years when it's being farmed by the owner himself. 7 years when it's being farmed by a tenant. Basically 2 years, like BPR, but if it has been farmed by a tenant, then 7 years will be there for us to match. While this exception thing is going to take us back to that discussion of replacement property. Remember, we have discussed that replacement thing there, takeover. One of the business property replacing another one. So it can happen for APR also, one of the agricultural property replacing another agricultural property. And then the combined period of the ownership must have to be checked in. This is the same thing. Like I told you, if the BPR you have learned it, lot of things coming back to your way in APR will be the same as above. Remember that discussion of replacement property and that application of takeover on it. Combined ownership was looked upon when one of the business property was replacing another one. Same can happen for APR. One of the agricultural property is replacing another one. Combined period, and the combined period has to be the same. 2 if farmed by owner, 7 if farmed by tenant. This you already have seen over here. 2 out of 5, 7 out of 10 if farmed by the tenant. There's nothing needs to be talked about further, as you already have seen me even performing a question on that. Same as that. One extra thing in the API, you have to respect that 7-year thing when farmed by the tenant, which is continuing even over to that side. Okay. An interaction with BPR. How will it be interacted with BPR? Sometime when there will be a transfer of an unincorporated farming business, BPR is available when you make a transfer of unincorporated business. Remember? But now, if that unincorporated business is a farming business, so just because it's a farming business, APR is applied. And just because it is a business, APR will also be applied. understand? I make a transfer of my farming business to someone. So just because it's the transfer of unincorporated business, so it's BPR. And just because it's a farming business, so APR will even be applied on that. It's not a trading business, it's not any other business, it's farming business. So it will attract also APR over and above to BPR. That's written over here. But agricultural property forms the part of an unincorporated farming business. And you should not forget the definition of agricultural property that I have defined above. Farmhouse, farmland, pastures, pig shed, barns. If agricultural property forms a part of an unincorporated farming business, the APR is given before BPR. APR is only available onto the agricultural value, while BPR is available onto the remaining business assets. Means when you have to apply APR, you will not be apply the APR to the entire business value, just the agricultural value associated to that one agricultural property, while the BPR will be available on the rest of the business assets as normal, provided the conditions of BPR we already have checked. This can nicely be seen in application number 10. Tim plans to gift his farming business. The moment you will see this term, gifting the farming business, suddenly you will start thinking of, oh, this will take me down to APR, BPR both. This transfer of business is BPR and farming business is APR. In APR, when I will only apply the APR to the agricultural value of the agricultural property in that business. All the rest of the assets will take BPR. Tim plans to gift his business asset and 30,000 cash to his grandson on the occasion of her marriage. Oh, so on top of that, marriage exemption will even be applied. And it's a grandson. So for grandson, the exemption for the marriage will be 2,500 because it's a grandparent relation. He has made no other gifts in life preceding 7 years. Tim lives on the farm and has owned and worked for the business for the last 17 years. So this has satisfied the criteria of 2 years for BPR and APR both. As it's farmed by the owner himself, there's no tenant in it. Farmed by the owner needs to satisfy 2 years for APR. A survey has recently valued the Tim's farm and its land as follows. So this is the total value of farming business, which has got agricultural value, development value, market value, animals and inventory, cattle, plant and machinery and motor vehicles. This is the total market value of farming business that he today makes the transfer of. So in other words, you even can call this to be as transfer of value. But transfer of value, this is the value of the business he makes the transfer of today. But this transfer of value, we know that is subject to APR, subject to BPR, subject to marriage exemption. So let's go to work this on the next page, application 10. In the entire explanation, you can clearly see we're not today working the inheritance tax liability. We are rather trying to find the chargeable amounts of transfers after making the use of these reliefs that we have studied today, BPR and APR, over and above to exemptions that we have studied in the past. The transfer value is 1270,000. 1270,000. No, in fact, there are two things being transferred. The cash is another thing. I have first of write the transfer value of this business, farming business, the first thing. And the second thing that's been transferred is cash. So the value of farming business is 1270,000 over and above to the cash, which is 30,000. Is it? Yeah, 30,000. Transfer of business and cash is on top of it. So the total transfer of value is
1.3 million, is it? Am I right?
Yeah, this is the total value of transfer we've been able to get. Yeah.
Is this subject to APR? Is this subject to BPR? Let's go and check the conditions before we really apply. But definitely, we have got this marriage exemption coming to our way next to it, like always. We have got this annual exemption coming to our way, like always. Which tax year this transfer was being made in? It's on 21-22 tax year. So I should have to go and take the exemption of 21-22 tax year first. Because I can write these exemptions in advance and concentrate hard on the rest thing afterwards. BPR has to be applied after, APR has to be applied first. Now, APR is only applicable to the agricultural value of agricultural property. And at 100% because it's not farmed by the tenant, it's farmed by the owner himself. So the rate has to be 100%, but to which value I should multiply it to? That requires me to go back to a question to find the agricultural value, and that they have given to us as 700,000. APR is only available against this, not to the rest of the assets, because the rest of the assets will be eligible for BPR. There you go. I have been able to subtract the 700,000 from. Coming down to the BPR. So BPR is available at 100% rate. Yeah, because it's a transfer of an unincorporated business, and transfer of unincorporated business attracts 100% BPR also. To which value I should apply it to? Remainder. What is remainder? 300,000, 180,000, 90,000. The remainder has to be 300 plus 180 plus 90. 570. That is where the question has come to an end. The final answer for this question has turned out to be 21500. This is the charge. See how are you making the use of those reliefs within the body of what we already know. That is it. And what if he makes the transfer of his interest in a farming company? He has an interest in a farming company. Obviously, interest in a farming company means shares in the farming company. And he makes the transfer of that shares to someone, gives the shares to someone. So relief will still be available provided he has an ownership of more than 50%. This is the basic condition we have been watching it since the start. The hold has to be more than 50% for the APR to apply. APR is given against the agricultural value that can be attributed to the shares. Agricultural value. Only the APR is available. And just because the control thing they are talking about, the related property holdings must have to be applied as always above. As always, we have applied above. To determine a control, that related property valuation is going to be a part of explanation of this. Let's do this question to finish it off the API here. Since 2010, Jade has owned about 80% of the shareholding, so that already has satisfied the condition of more than 50%. If today he makes the transfer of these shares to someone, the API will become applicable, but only to the agricultural value of the property that is attributed to the shares, which owns the farmland. Yeah, this farmland is an agricultural property. What is the value of that farmland? They have given to us down below. On 31st of August 21, Jade gifted the shares. So finally, the gift of shares in the farming company is happening. And the gift of shares in the farming company will not just attract the APR, but also attract BPR. Why? Because these are the gift of unquoted trading company shares. So unquoted trading company shares attract BPR over and above to APR. The value of these shares are given, which is a transfer of value. And now they're providing us the whole value of the company within which the value of the land is 8, the value of other asset is this. And this will be the one attracting the APR. The farmland has been let to tenants for previous 10 years. The agricultural value of the land was 320,000. The other assets of 180,000 were all used in Tesco's limited trade. What is it? Although this is an agricultural property, the value of that they have given is 380,000, but down below what they say is that the agricultural value of the farmland was 320,000. So if the 320,000 is the agricultural value of this land, then what is the rest in it? 80,000, sorry, 60,000. See, this is the agricultural value. Then what is the rest of the 60,000 in it? Farmland is agricultural property. The value of that is given as 380,000. But down below this suggests the value of the agricultural is 320,000. Then what is the other 60,000? This is called a development value, which will never attract the APR. You probably have seen that in the previous question. Agricultural value was 700,000. Development value was 300,000. So the total value of farmland was 1 billion. And what has attracted the APR? Only the agricultural value has attracted the APR. So the same thing you can assume over that if 320 is the agricultural value out of 380,000, the 60,000 must have been a development value. And the total value of farmland is 380,000 because of this reason. That you previously have seen, the agricultural value was 700,000, but the development value was 300,000. And that's how the way the total value of farmland was 1 million. Same is happening over there. Okay, so everything needs to be nicely noticed. So transfer of value application 11 is given as 430,000. Next thing is to deduct the APR. Next thing is to deduct is the BPR. And yeah, the typical annual exemptions from the tax year. Which tax year? The gift was made on August 21, same 21-20 tax year. This time it's not a wedding present or something like, so I should involve the marriage exemption into it. The APR. Okay, so to calculate the APR, I need to use that prorating task. The agricultural value is 320,000 divided by total value of the business, 560,000, multiply it by the value of transfer, and obviously the rate, which is going to be 100%. Same bracket I have to repeat, but will only use 180,000 now as a business asset. 180,000 divided by 560,000. I'm trying to only find the portion. It's like a mathematics. You're trying to find out of the total value of business, what belongs to agriculture, what belongs to other business assets. So it's like a percentage you will be able to find, according to which the BPR and APR will be applied. That's what I'm literally doing. But you should not be using 380,000. Remember, we already have been able to separate the development value of land and the agricultural value. Agricultural value has only been used over here, not total value of land. 320 divided by 560 multiplied by 430,000. That turns out to be 245,714. 180 divided by 560 multiplied by 430,000. That is about 138,214. That's the final answer. Ended up getting 430,000 minus 245,114 minus 138,214 minus 6,000. That's the total I've got. Chargeable amounts have been a focus of ours throughout the course. We've been trying to find the chargeable amounts by making the use of the two new reliefs we've understood today, APR and BPR. A lot of conditions to respect in it, a lot of things to remember in. then you'll be able to apply those reliefs. Not as simple as the annual exemptions to apply was, or marriage exemption to apply was. While this exception thing will still be applied to APR the same way as above. APR will be restricted when the farming company holds the accepted assets in the same way as studied above for BPR. So that does not require to have any explanation. Same as above. Even the withdrawal of APR will follow the same path as I have done it for the BPR. Remember that discussion. For a live rent transfer, the conditions of APR one has to consider at the time the gift is made. An APR is given when calculating at 100%. Before applying any reliefs and exemption, and even before applying BPRs that you have just seen. For the death transfers, if the gift becomes chargeable once again, APR will be considered once again, provided the two conditions specify that the property must have been still a relevant agricultural property and still be owned by the donee the time of the donor's death. Exactly the same two conditions you have seen me talking about above. Check this out. Just the word of business being changed to agriculture. BPR has been changed to APR. Nothing has become different. See, asset is still a relevant agricultural property and still owns by the donee at the time of donor's death. If the two of the conditions above are not satisfied, APR is withdrawn. And with that withdrawal, you remember we have to add back the value of APR into the chargeable amount of transfer purpose of NRV computation that ends up the APR. Didn't I say to you that when you will be done with the PPR, learning the APR will become just an easy job, has taken even a less amount of time. When you will come down to revise these two reliefs, have to revise it like a one package. Neighbors to each these are. Lot of things for the BPR we have understood, same applies to BPR or with a little different way, but overall the same. The course started off about 1.5 hours ago. We started off these two reliefs and we have finally finished. Although we are in the course now for about 2 past hours, but the first 30 minutes was about a revision, connection. Then we started the course after 30 minutes of that intro. And now about 1.5 hours, we have finished it off. Extensively everything that one can possibly talk about I have. A lot of questions being put into it for you to understand, when sometimes you don't understand things by reading the text, these questions will do a task. The one belief that we are left, which is an easiest one to learn, we will do it after a break of 15 minutes, quick succession relief. And then we will also do this question application number 15 to end up this topic. Quick succession relief is going to be as small as possible explanation, will not take more than 15 to 20 minutes. As you can see, hardly a text is written there for it. So all come to your way after a break of 15 minutes when we will resume the session. We will start off. Stay tuned. Do not go anywhere. I will see you in 15 minutes to continue. Okay, I'm back. Hoping you're also there with me in the continuation of the course of today. Getting into the last story called as quick succession relief. And this relief is not the same as DPR and APR, as it does not reduce the value of transfer. It rather reduces the liability of inheritance tax. It's a tax reducer. It's a tax credit which reduces the liability of inheritance tax on the death estate computations. It's totally different. Let's go to understand the quick succession relief, QSR. Let's try and understand the basic theme of this word quick succession relief. It is a tax credit which reduces the inheritance tax liability, not like the APR or BPR, which reduces rather the value of transfer. Transfer of value was reduced, not the liability we have worked so far in any of the question we have done. Why this tax credit has to apply and to whom this credit will be available to, and why this word quick succession is used over. See this case down below. This is Mr. A, who has died on 2019, and this is Mr. B, who has died in 2020-21. Okay, let me write exactly the dates. 31st of December 19, he has died, while this person has died on June 2021. So in both of the individuals, they die in quick succession. Quick succession means within 5 next years. This 5 is not an example. To explain the word quick succession, that 5-year thing has to be remembered. That if 2 of the individuals, they die in quick succession, which means if they die within the 5 years, the one of the individual is died, and within the next 5 years, another one dies. That can be 4 years, 5 years, 2 years, 1 year, 3 years, but should not be more than 5. Then this topic will not be applied if the death of the second individual is more than 5 years after. So intentionally in this question, in this example, I have been able to write the 2 of those deaths in quick succession. Roughly, if you count, it's not going to be more than 2 to 3 years. So the topic becomes applicable. Mr. A has died on 31st of December 19. And the value of his death estate, including the assets like car, buildings, businesses, and all. Same like in the past, you people have done, he might have been having a car, he might have been having a business, he might be having the investments into shares, residence, etc. Suppose he has made the transfer of the business to Mr. B upon his death. That can even be Mr. A's relative. Can be an aunt, can be an uncle, brother, sister, daughter, father, son. Not necessarily it has to be a spouse. It can be anyone who is not even in connection to. So this business has been transferred to Mr. B upon his death, or you, in other words, you can say that Mr. B has inherited that business from the Mr. A on his death. Now this business has been owned by Mr. B after it has been inherited to B upon the A's death. And today when he has died, obviously on this transfer, there will be an IST being paid, death IST. The way that we people work the death IST on the death state, we have worked. You know how to work the death IST on death estate. So the chargeable estate of Mr. A was computed and the death IST was worked on. It means that business that he has made a transfer of, the IST already has been charged onto it. And today when the Mr. B has died, being the part of his chargeable estate, this business will become chargeable once again. He might have got some more assets with him. He might have got some shares. He might have got some bank balances. But this one is the one that's been transferred to him upon the death of A, and is going to become chargeable once again today, being the part of his death estate. Same business in the past 5 years being charged on the first death, becoming chargeable in quick succession on the death of second person. This person, in that case, will go to get the quick succession relief. QSR will be applicable to the person to whom this business has been transferred to. It's like a relief, so that the same business should not be taxed in quick succession when the two of the deaths are taking place within the span of 5 years. This 5-year thing is very important because this topic only applies if the death of two persons are within the 5 years. If the death is not in the 5 years, this topic won't be applied. See the word quick succession. So quick succession over here means 5 years. The two of the deaths have to be in the 5 years to say quick succession. The same business that was once being taxed being the part of his death estate, becoming taxable being the part of this estate also. So to avoid having a double taxation on this business, this person will be getting a credit of paying a little less tax. There is the formula I have to come and explain to you, which I can. Idea, the sense of the whole topic, I at least have been able to explain that what is QSR and who will be getting the benefit out of it. The one who has received an asset will be getting the benefit of, not the one who has transferred on the first death. In my question, we will be calling frequently first death, second death. This way we will be calling. Not that the same person has died twice of a time. First death means the death of first person. Second means the death of second person. So because I will be able to call it just to distinguish it. First death means the death of first person. Second death means the death of second person. So who will be getting the benefit of QSR? The one who has died later, second death. As on the second death, this business is going to become taxable second time around in quick succession. That person is supposed to get the benefit of tax by getting the QSR. You get the whole idea, right? There are no conditions one has to satisfy. There is no qualifying period of ownership one has to have. Belief is totally different. And the application of that totally depends upon if two of the persons they are dying within the span of 5 years. And these can be the family members, and usually a case. Because on the death of one person, usually the assets are passed on to family members, brother, sister, father, daughter. So usually the case will involve family members. Spouse will not be involved because spouse transfer is an exempt transfer, because transfer to spouse is totally an exempt legacy. It will be another family member, brother, sister, daughter, father, son. Spouse will not be involved. Then in that case, the whole of the transfer is exempt. The QSR cannot be applied. Okay. So how to calculate the QSR? There is a formula to calculate And the percentage, like in the past, people have used that percentage paper relief, depending upon the whole gap in between the death day and the gift day. More or less the same task we have to do. We have to see the gap between the first death and second death. That is the second death took place in 1 year, or more than 1 year, not more than 2 years, or more than 2 years, not more than 3 years, or more than 3 years, but not more than 4 years, or more than 4 years, but not more than 5. So according to that, we will have to use this percentage of QSR. I can show you that table. That is this table I am talking about. Years in between the first death and second death. First death of first person, second death of second person, not the same person died twice of a time. I already have told you. First death, when I mean to say the death of first person, and second means the death of second person. Two persons will have to be involved. More than 0 years, less than 1 year, more than 1, less than 2, more than 2. According to that, we will have to pick that percentage, like paper leaf in the past, 20% difference, 20, 40, 60, 80, 100. And see, the more the close the two of the deaths are, the greater the relief. More the close means the both of the persons, they are died probably in a matter of few months. One death and followed by the second death in the matter of months. Maximum QSR will be. And obviously you don't see more than 5 years, because more than 5 years is not QSR. This percentage one has to apply it with IHT on first death. Will this IHT on the first death will be given to us? No, it will not be given. This will not be given. We will have to calculate. Needs to be calculated, and I can explain to you that way to calculate, because that percentage you'll be able to calculate by simply noticing the gap in between the two deaths, 1 to 2 years, 5 to 6, 4 to 5, easy job. But finding the IHT on first death can be a bit of a challenge. This is the formula one has to use in computing the IHT being paid on first death. Either given in question or can be calculated as. Sometimes it's given, but most of the times we have to work. And how to work? You will be able to see the demonstration of that in application 12. Then you will be able to look into that formula afterwards, on which the QSR will end. Yeah, if you want to read the text written before, I can show to you. Quick succession value applies when individual dies, and within the previous 5 years, they either had inherited the asset. See, inherited the asset in the previous 5 years. This person has died today, and in the previous 5 years, he has inherited the business, which was charged on the death estate. So it was charged on the death estate of this person, or received a lifetime gift, which was charged. For example, a situation where two family members, they die within the 5-year period. First person to die having made a bequest to a second person. QSR is a tax credit against the IHT liability of an estate of the individual receiving an asset. See, over here, I was telling you that the one who has received an asset will get the QSR tax credit. The amount of QSR where the death occurs depending upon the whole percentage which people have seen. Hardly any text is written there, which in a best possible way I have been able to explain to all of you in this way, which later when you come and try to look back into the lecture notes, you start feeling it like, fine. Let's do this application too. Gloria died on 31st of October 2021. That's the first person. Or probably the second one. First person may have died earlier. We still have to read the question. This is the estate that she has left. Means this is the total value of estate that she has. She had no lifetime transfers, but her estate did not include any residential property. Why they have written this point? So that we should not think of applying the residence NRE. In August 18, Gloria had left 19,000 from her brother's estate. Now, finally, they have told her brother has died earlier on, and she has inherited 19,000 from her brother on his death previously in August 18. So his brother has died back in 2018, which looks to be pretty much in the last 5 years. So when his brother has died in the past, this 19,000 was charged on his estate. Inheritance tax of 80,000 pounds was paid on the chargeable estate of 490,000 as a consequence of brother's death. So now they're telling us the whole history. When brothers died, this was the IHT that's being paid on the estate of brother. The total value of brother's estate was 490,000. So let's start off with brother. Let me try and draw the same kind of a picture. Application number 12. Difficult thing we already have done in the first half of a course. This is something that in the end we have to finish it by. So this is a brother and he has died back in August. Exact date is not mentioned. They just have mentioned August 2018. His total death estate was 470,000, out of which he has transferred, gifted 19,000 pounds to his sister. The name of the sister is Gloria. I told you it can be any family member. The wife will not be involved because wife will then be a totally exempt transfer. So out of that death estate, he has transferred 19,000 to his sister. Good. Obviously, they say that on this death estate, the IHT that was paid by the death of the brother was 80,000. So this is the IHT was paid, total IHT. The inheritance tax of 80 was paid on the total chargeable amount of 490,000, not 470, 490,000. Good. Got it right? Followed by the glorious death. When is she died? Gloria has died on 31st of October 2021. So first thing that we have to see if she has died within the 5 years of the death of her brother in the past. I'm pretty much satisfied. That's 2018. That's 21. That's not going to be more than 3 years. So quick succession relief can be applied because of this 5-year rule at least. Gloria's death estate is 470,000. Gloria's death estate means the chargeable amount of the Gloria's death estate is 370,000. We will have to use her NRB fully. She has made no transfers in the past. I mean, this is not the question that you can think of applying the API DPR. Why? The question does not have any agricultural property. The question does not have a transfer of any sort of relevant business property so that we can think of applying the DPR. So I'm just using the amount that's been given and using the NRB, which upon this adjust, she has made no transfers in the past. So whole NRB I can come to use it against. Residence NRB can be an option to use, but that option does not even exist as she does not own any residence. So that becomes taxable. What becomes taxable? 370 minus 325, 45,000. And as a result of it, the IHT at the rate of 40%, you must have been wondering where is the QSR has all gone. I'm coming back to it because QSR is applicable to the liability. This is where the QSR has to come back into my discussion. So I first of all have to work the inheritance tax, which is what I have done. Now she is going to get the benefit of QSR, provided the topic satisfies the condition. But this is the placement of QSR next to the liability of inheritance tax. And the way the liability is worked that way is something that you are aware of.
To apply the QSR or not, the first thing that I need to determine the percentage. So for that reason, let's go to see the gap in between the death day and the first death and the second death. That's 2018 August. That's October 21. So August 19, August 20, August 21. I already counted 3 years and still there's no second death. But I cannot take August 22. So it's 3 to 4. Not more than 4 years, but more than 3 years. So that will make me to use what percentage from that table? 0 to 1, it's 100%. 1 to 2 is 80%. 2 to 3 is 60%. And 3 to 4 is 40%. So 40% QSR, I will be having a chance of using. The only thing that now we have to work, which I have told you will not be given to us, is IHT on first death. This is what we have to calculate. We need to find it out on the transfer that her brother has made to her in the past. What was the IHT paid on it? So that I will give this person a total relief onto it. So for this reason, I need to know the value of transfer that's being inherited to sister, 19,000. And what amount of IHT being paid on. Because tax credit will take the tax effect of that transfer, not the value of transfer. You're not supposed to deduct 90,000 from there. That's the value of transfer. You're supposed to deduct the IHT over to that. Whatever the inheritance tax being imposed onto that transfer upon first death, that will be a deduction over it. So to find it out, the formula is, it's literally a mathematics. Can I find the effective rate of inheritance tax on the brother's death estate? Effective rate, how can I find it out? By putting the total tax in numerator and total value of death estate in denominator. Now that's literally a mathematics. I'm trying to find the effective rate of tax, putting the liability in numerator, total chargeable amount in denominator. So what is the effective rate of inheritance tax? His brother's death computation being taxed on 80,000 divided by 490,000. So effective rate is 16%, not to be exact 16%, rounding it off. 80,000. Although the death rate of tax is 40%, but from where we have got this 16% from, it's effective rate. Effectively, the death estate of his brother has been charged. This is the effective inheritance rate. Her death, his death computations. Let me write it as effective inheritance tax rate, IHT rate. IHT itself means inheritance tax. Effective IHT rate of tax, 16%. Did I perform the right computations? 80 divided by 490. Yeah, it's 16. It's not exact 16%, it's 16.33. But I have to write it as a rounded off figure. But when I will work the answer, I will use the calculated one, the one the calculator will produce. So effective IHT that has been imposed on his death computation was 16%. So I can use that 16% to even multiply with this to try and get me the answer that what effectively is the IHT being imposed on that gift being transferred to brother or to sister. I can work this out. So ultimately in the background, I am using this formula which you may think of cramming, but understanding is more important. See, total IHT pay on first death estate divided by the gross chargeable amount of death estate. That's what I'm doing. Total IHT paid on first death divided by total chargeable amount. This will make me to calculate the effective rate of inheritance tax, which I can use it to multiply it with the value of asset gifted out of first estate.
The value of gift is 19,000. And whatever the answer I will get will be the one I will eventually be making the 40% rate of QSR business. So what is the amount we've ended up working? 19,000. I have to use the calculator answer. So I'm going to rewrite this numerator 80 divided by 490. This answer directly, I'm going to multiply it with 90,000 to get me what? 3102. Now this is called as IHT on first death. In regards to the value of asset gifted, this is the total inheritance tax on first death. But this is the inheritance tax on the first death in regards to that asset which has been transferred, 3102. This is the figure that now finally we've been able to finish. And the percentage I already have been able to identify. So I'm going to use this 3102 amount over here to finish my job. That figure, you do not need to come in directly that deduct. You also have to think of using the percentage of QSR units. That's another thing. 3102. Make it simple by learning it, not by grabbing the formula. So this is the credit she will end up receiving in her death computations and will end up paying this much less tax. This is called as quick succession. 40%, 60, 80, easy to determine as it will require us to just observe the deaths of the two persons and gap in between 3 to 4 years, 4 to 5, 5 to 6. But finding this figure can be challenging if you're not actually understanding the whole theme. The theme is we're trying to find the effective rate of inheritance tax on first death. Effective rate to find is in mathematics, total tax in numerator, total value of estate in denominator. This will work the effective rate for us. Use that effective rate to the value of the gift being transferred to find the tax on that transfer only, which is 3102. And then don't forget using the percentage of QSR with this, which we already have found out. Who is going to get the QSR? The one who has received an asset. And before then, that the computation will be the same as always. Chargeable amount, NRB. We could have transfers in the past 7 years that could have filled this off. We can have residence NRB the same as always. QSR just to be applied in the end when you are done with the liability computation. And this is where in about 30 minutes, this relief has come to an end. That's the QSR. So major worries, APR, BPR out of this chapter. Such a massive explanation we've been able to finish ourselves with. This application 15 is going to bring plenty of stuff in it together in it, and we'll be able to finish it off. This question will take BPR in it. This question will take rented property valuations also. This question will take death estate computation. This question will take residence NRB, normal NRB, death computations. QSR might be there, might not be there. Let's do it to finish this chapter. Calculate the IHT that will be payable as a result of Fiona's death. Explain who will pay and who will suffer the inheritance tax liability. Fiona died in a car crash on 17th of December 2021. Under the terms of her will, estate was left as follows: £130,000 to husband, £45,000 to a qualifying political party, and residue is going to whom? Son. The name of the son is Scott. And these two things are exempt legacies. So probably we will be able to apply that point of substantial legacies more than to 10% of the baseline amount to use 36% rate of tax, not 40. Or we end up deciding to apply 40. Because this is the way you have to check things by your side. The question will never tell you that, okay, you have to use that 36% rate, so go and check. You by yourself have to. The question involved the, but this question does not have any charity. Yeah. Qualifying political party, but we do not see charitable legacies in it. So no, that point is not applied. I thought this is charitable legacy, but now I'm looking into it for second time around. It's political party contribution. So this question does not have charitable legacy. So that point of taxing the IHT at 36% is not valid. After the death, at the date of death, Fiona owned the following assets: residence, and this probably will take us to residence at RB, flat in Bristol. Fiona never lived in this property. 3 shops valued at 42,000. Fiona's husband Fred owns one adjacent shop. Oh, this is related property valuation. Definitely. Fiona by herself owns 3 shops and her husband owns one. So this is going to take us back to that related property valuation, A over A plus B multiplied by the combined value of total shops. The combined value of 4 shops is 380,000. The villa situated overseas to 40,000. Oh yeah, that's $1. And so the reason why they have provided to all of us the rate of exchange for us to translate it into pound sterling by using that rate of exchange. Easy job. Half share of the partnership assets, which are being valued at 500,000. The partnership trades in the UK. Fiona had been in a partnership business for several years. So partnership assets, half of it transferred. This probably is going to be subject to BPR. Remember, transfer of an unincorporated business. If it is a sole trader, whole business. If it is an interest in partnership business, then the transfer of that interest in a partnership business subject to BPR, provided the ownership there is for 2 years or more, which is also becoming satisfied. Fiona had been having a partnership there for several years, which is definitely more than 2 years. So while I'm reading the question, I'm lots of doing analysis, deciding this is to be done, this is to be done, even for you people. 20,000 shares in XPLC. The shares were quoted, and when the shares are quoted, we have to value them by using the lower of 2 principles, quarter principle and average bargain. And they have provided to all of us the bargain prices and quoted prices. So I will be able to use that formula, lower of quarter principle and average bargain, all from this chapter, whatever is tested into it. And I told you, usually the shares and securities prices are quoted cumulative dividend, cumulative interest, unless or until the question suggests that this is excluding interest or excluding dividend. So the values that they have given to us are already cumulative. 7,000 units in CBA unit trust, and unit trust we take the lowest bid price. The lowest is going to be 129, and the bank balances. So everything is applied into this question. I don't see any agricultural property anywhere else. So API not going to be applied. I don't even see some QSR thing coming in, not applicable. BPR I have seen in one place, which I will make the use of. Related property valuation I have seen in one case, I will make the use of. Fiona's outstanding income tax liability was 8,500. Expenses were this. She had made no transfers in the past. Let's go resolve it. Application 50. Okay. The first thing is to find the finalize the value of death estate. So for this reason, I'll start making the list of everything, starting off writing the residence in the first place, which is 628,000. Then we have the flat in Bristol. The value of the flat is given as 170,000. And then we have the 3 shops. Shops will require to have related property valuation, so I can leave a bit of a space next to it to work that answer. How many shops does she own? Three shops, each is having a value. So what will be the value of three shops then? 42,000 multiplied by 3 times. That's 126,000. This is going to be A over A plus B. B is the value of the shop being owned by the spouse, and that's about just a shop. The value of that is 60,000. Fred owns one adjacent shop valued at 60,000, so I will be able to use 60,000 over here. A plus B multiplied by the combined value. So combined will be how many? Three shops by her, one shop by him, total 4. The combined value is given right into the next line, 380,000. So if you do not have this knowledge, you will not apply, and this is where you will lose marks. Although it's a small thing, but we sometimes focus on bigger things and lose focus onto these small aspects, which are as important as the bigger aspects. So this is the value I should go to write for the three shops: 257419. Villa situated overseas worth $240,000. The pound sterling is $12 to 1. So if I divide the 240 by 12, it should give me an answer of 20,000 pound, I guess. This is a villa that's situated abroad. 240,000 divided by 12. Yeah. Dollar should give me the pound sterling 20,000. Is it? Okay. Half of the partnership assets, which are being valued for 500,000. So partnership interest. This I can write it in inner column. I might have to apply a BPR over to it very next to. Yeah. So the value of the partnership interest is 500, but they have sold the half share. Half share will be the 250,000 of it. And then the very next to that, I'll be able to use the BPR. And BPR on the transfer of an unincorporated business, may it be a partnership business or a sole trader, is 100% BPR. It was in fact the first relevant business property into the list of 4. That takes the whole value down to 0. Eventually, what will be passed on to outer column will be 0. 20,000 shares in XPLC. So this will require to have a bit of evaluation. So I can take the next page to perform this computation. A BPR is applicable not just to the lifetime transfer, it's also on the death rate also. So there we have applied the BPR not on a lifetime transfer. We are rather applying this to death state. BPR and APR both applies to lifetime and death computations. This is what you also can see while in my lecture notes for the reliefs. See, lifetime transfers and death transfers. The BPR and APR both apply. So right now we are having a death estate with us and we are applying the BPR onto it. There are no pets and CLDs. Whereas most of the questions we have done while working the BPR in the class today had a lifetime transfer in, pet CLDs. It's applicable to death estate the same way as it's applicable to lifetime transfers. Where QSR is only applicable to death estate, as it's the matter of reducing the liability of inheritance tax on death. Okay, getting back to the facts of the question, we are going to revise that computation, the lower of 2 things. Quarter of principal and the average bargain. Lower of two things, the quarter of principal and average bargain. The quarter of principal takes the highest quoted price minus the lowest quoted price, which is 196,204. 204 minus 194 divided by 4. Yeah, plus the lowest quoted price. And the average bargain is about taking the highest bargain and the lowest bargain divided by 2, 194, 210 divided by 2. So the value that we have got from the first bracket is 204 minus 194 divided by 4 plus 294, turning up to be 296.5. 194 plus 210 divided by 2, that's about 202. Selection is based upon by picking the lowest. Oh, that looks to me the wrong answer. Yeah, because this is 196, not 296. 196 and 204. Oh, it's not 204 and 196. It's not 194, that's 196. So altogether, I have wrongly placed 204, 196 plus 196. 204 minus 196 divided by 4 plus 196, that's the 198.5. Now I find this to be as the lowest one, since 210 plus 194 divided by 2 is the heavier one. So I end up selecting this, which I will use it up there to find the value of those, how many shares? 22,000 shares. So 22,000 shares multiplied by 198.5 pence. I figured that out to be 4670. 43670 43670 198.5 or 0.198. Okay, good at this. And then we have the unit trust. For the unit trust, we just have to choose the lowest bid, which is 129, 7,000 unit trust. Units in CDA trust. It's 7,000 units multiplied by 0.129. The lowest of two has to be chosen. We have 129. Multiply this by 7,000. The figure turns out to be that's 0.129. 129 pence is 1.29 multiplied by that is 9030. That means it has to be then 198.5 divided by 100 has to be 1.985. This is 1.985. 1.985 multiplied by 22,000. The figure has to be 43670. The answer is good. So we are finalizing the value of debt estate. The last thing to add it in is going to be a balance of bank 59340. And then he has got some taxes to pay. She has got some taxes to pay, outstanding taxes and funeral expenses. Taxes payable and funeral expense 8,500. Funeral expense is 2200. So even finding the death estate, the finalization of death estate can even be a time-taking task. As you can see, in this case, we are the value that we have got 628,000 plus 170,000 plus 257,419 plus 20,000 plus 43670 plus 9030 plus 59340 minus 8,500 minus 2,200. That figure turns out to be 117,67 59. Yeah. Provided the computations have not been the issue, this is the chargeable amount of state been able to work. It's not done yet because we're getting onto the next page to try and work. We're getting onto the next page to try and work the taxation. So I copy and paste this amount onto the next page, chargeable amount. And then we will use the exemptions. There are 130 has to pass on to husband and 45 has to pass on to a qualified party. These are called as exempt legacies. The one that's going to husband and the second that's going to political party, qualifying political party. Figures are 130 and 45,000. And this is going to be the final chargeable amount after making the use of those exemptions. Minus 130,000 minus 45,000 should be the final 100, 1759. 100, 1759. 100, 1759. 100, 1759. And then comes the residence NRB. And that's NRB to apply. The conditions to satisfy the first one, he should be owning a house which she, to whom the house has been passed on to, Scott, direct descendant. So that is an NRB will be applied. The selection is based upon by making the lowest. 175,000 is lowest, 621 is not the lowest. So I'll end up using 165,000. That is all the basics of the inheritance tax. You people have been doing it in all the past of your life. No transfers in the past she has made. So the whole of the NRB is there to use it. What becomes taxable will be taxed at 40%, not at 36%, because this question does not have any charitable legacies. This is the answer that I can say to be as the taxable amount 501,759, and at the rate of 40%, the figure turns out to be 200,704. That was required in this question and we have finished it. On the way, a little bit of BPR we have applied, a little bit of latent property valuation rules we have applied, shares valuation by using the lower of two quadrat principal and average bargain, and for units we just have chosen the lowest bid price. But lots of things in this chapter we have done, not this question to possibly bring it in, requires to have a good revision. After spending quite much of your time off the course of today, the past course, we have finished ourselves with inheritance tax of whatever has been scheduled in advanced taxation. Except double taxation relief, which will be talked about once we will understand the overseas aspects in a separate chapter. Okay. So as from today, now we are getting into a discussion of the income tax, which you people are aware of, that is always a bigger area of the taxation course. The knowledge that's been given to you for capital gains tax, the inheritance tax needs to be at your side. You have to revise, because if you will not, you will not be having a chance of doing anything later. The questions of the exams are not like that you will be tested on capital gains inheritance tax only. When the questions are tested, it takes the interaction of taxes. which means you will be asked to answer on the same question by keeping the knowledge of income tax, inheritance tax, capital gains tax, stamp taxes also we have done, and the value tax also from individual side. And when you are tested from the company's perspective, then you are once again tested back on stamp taxes, value added taxes, corporation taxes. So at this point of time, we cannot get into the exam practice unless or until we are done with the income tax also. So the knowledge people already have gained now for capital and inheritance tax, that's your job. You have to keep on revising and keep yourself in touch with those revisions from the recordings, from the board works that you have. And in the course, we will concentrate on the income tax for all the time to come. The first chapter of income tax is totally on introduction and it does not bring anything new. Income tax, basics. Let's start off by the definition of income tax, who is liable to pay, what this tax is all about. So income tax is payable by an individual on the earnings in particular tax year. And you know your tax year is 21, 22. That does not require to have any debate. You know this tax year starts on 6th of April and completes the cycle on 5th of April. While the individuals will have to be the ones, those are UK resident or UK ordinarily resident. Or the person can have lots of incomes. Earnings can be of many types. That person can run his own trade and making the profits of trade from trading income, which is what we call it as. The person can have be in employment and earning an income of employment from. The person can be a property guy who lets the property out and getting back the income from property income. The same person can have some deposits in bank and from that can have some saving income and can have some investments into stocks to get back the dividends from. All of these examples are being given to you so that you in the first place gets to know that this is what a person can earn, and there can be a lot of income, pension income, other income, we will see with the time to come. But these are the basic heads of income: trading, property, employment, savings, and dividends. Arising in a particular tax year, individual pays tax on. It's called as income tax. I guess not more time I have to spend onto it, as you people already have the idea of that from the past courses. Individuals pay income tax on their earning arising in a particular tax year. Which of those individuals? Those are either resident or ordinarily resident in UK. On the tax year starts on 6th of April, ends on 5th of April. Because your financial year is 21, so tax year starts on April 21, ends on April 22. This tax year is called as tax year 21-22. Aren't we aware of that? And these are those incomes we've been talking about: employment, from employment, for example, salary, bonus, and benefits; trading income, the profits from the trade; property, by letting the property out and getting the rental. Savings will take all sorts of interest, while dividends will take dividends, other will take any sort of incomes like pension. Detailed rules of how these incomes are to be taxed and to what extent they are taxable, we will look into that later on. Chapter 1 is just focusing on computing the liability, not how to calculate each of the income, because on each of the income we have got things coming to our way respectively. If I have to show to all of you all the chapters of it, under the banner of income tax, see that the topic of employment income will be having its own chapter within which we will be studying employment income and NICs. Then the property and other investment income will have got its own explanation, property and investment income. Then we will be having the chapter of trading income, new and ongoing unincorporated businesses, which means trading business, a trading income. So for every type of income, we have a separate detailed explanation, which we will be talking about. The focus of this chapter is to work only on the liability computation, which is what we will start understanding as from the dates. And this is the pro forma. You people may have been quite much aware of this pro forma from your past studies. It's called as income tax return. Clearly, this is being spread out over the two of those pages. And part by part, I have to come and explain. If you just have to try and have a look onto it like a picture, clearly we can see there are three columns: other, savings, dividends. So how we have classified them into three? Why are they classifying these into three? I will come to talk about everything, followed by some of those deductions named as reliefs, personal allowances. Then the liability computations, you can see some band limits are involved, some rates are involved, savings income, dividends income. So let's start off it very formally. The first thing that needs to be looked upon is the classification of income in into three categories. Why have we been able to classify the income into three classes? I can explain that to you. And how to do it. First one is other, second one is savings, third one is dividends. So how have we done? Why have we done? What's the whole purpose of it? Other income is also called as at times non-saving income. So why are we calling it? All or sort of interest will come under the banner of saving, while the dividends will take dividends. And this column will take any income other than savings and dividends. Any income other than saving and dividends is called as other income. Any income that's not the dividend, that's not the saving, will be another income. Trading income, property income, employment income, pension income, or any miscellaneous sundry other type of income. Why are we classifying the income into three columns? Why can't we just add them together? Because the rates of the taxation are different for savings dividends. So we cannot have the one figure to apply one flat rate over to it. We rather need to have three different figures so that I can pick that amount and apply the relevant rates.
That's the reason why I've divided the whole income into two parts. Looking down into each now, see what's coming in under the banner of other income. Trading, employment, property. What's coming under the banner of savings? All of the interest. Bank interest, building society interest, other interest income. And what's coming in under the banner of dividend? Dividend. That's how the columns will have to be decorated in first place. Will be decorated in this way. Got it right. Then you see what next comes to is the total income. And total income is the total of all income. This is the total of other income. This is the total of saving income. This is the total of dividend income. So the reason why it's called as total income. You all can see there are three tiers: total, net, taxable. And there's a difference. You can't be casual on that. You cannot be casual on that. Total, net, taxable. There are three stages. And under the banner of each stage, you also can see something is deducting from qualifying loan interest, loss relief, personal allowance. Can you see? So let's try to understand what comes on to our way first, the relief. So from total income, when the reliefs are deducted from, this is called as net income. Yeah, the question does not have reliefs, the total, the net, the same figures. But if the question do have reliefs, the amount of income that's before deducting the relief is called as total, and after it's called as net. And there are two reliefs to go with by. The first one is called as qualifying loan interest. And second one is called as loss relief. Now this loss relief, we will be doing it later. To be covered later, to be continued, to be covered later. In loss discussion, we will have a chapter of trading losses. We will be doing that there in this chapter. We will be having the discussion onto those losses. One chapter has got a lot of things into it. The number of chapters, although are not many, but one chapter will have plenty of pages. Yeah, this is the chapter we will look into it, the losses. So we will have to have a quite bit of a wait to get into that and learn. What we will do today is only a qualifying loan interest. So there are two reliefs. The one we will not be discussing it in chapter 1. One we will be discussing. What makes the loan to say qualifying? As the name suggests, qualifying. If the money that's being borrowed been used professionally. What makes the loan to say qualifying? If the money that's been borrowed being used for professional matters, for example, buying an asset for business, buying an asset for employment, the interest paid onto that loan will also be called as qualifying loan interest. That will be that. If you look into this on the page where it has been talked about, you will be getting the same sense out of it. You will be getting the same sense out of it. For individuals, loan acquired by employee.
to purchase an equipment for employment duties. Loan acquired by individual to purchase plant and equipment for business. The theme is saying that the person may be an employee, may be a trader, using that money to acquire an asset for business reason, for employment reason. Similarly, if that individual is a partner, borrowing that money to bring an asset into the partnership business, or just to bring in a cash in a partnership, injecting more cash into partnership business, so professionally used. Or if the individual is an employee of an employee controlled company, employee controlled company is the one in which employees collectively hold more than 50% of the rights in a company. That company is said to be as employee controlled company. So if I am an employee of a company and borrowing the money to buy the shares in that company, which effectively means investing into that company, all of those things will have got the same feel into it, that money being used for professional matters. Not I borrow that money to buy a car for my family, or aircon, or TV, or television, or even a house for my family. That's non-qualified. Qualifying loan interest is deductible. These are those qualifying purposes in detail I have been able to show. So this is total income, 10,000, and the qualifying loan interest of 7,000 has been deducted from, that is called as net income. So why we are calling it to be as a relief? Because I was supposed to pay a tax on 10,000, but I will end up paying tax on 3. This much of the income is now being relieved. The lower the level of income I have, definitely lower the tax I will end up paying. In the second possible scenario, the qualifying loan interest now has turned out to be a figure bigger than that, 12,000. What in this case we have to do? What is the maximum the income is there to absorb? I am only allowed to deduct. The portion of qualifying loan interest that's being left relieved is called as unrelieved QLI, which in this case is 2,000. Can we do something with that? Can we try to carry it forward like annual exemptions? At times we carry forward, capital losses at times we carry forward. No. This will be a WASTEE, big waste. Can't do anything. Maximum that you can deduct, you have to. Any amount that's not been will be a waste. Okay with that? Yes. I have to deduct this qualifying loan interest out of these incomes in a order that's been given to us. The same sequence is what we have to follow as it has been suggested. Go with the flow. First of all, from the column of other income, then from the savings, and then from the dividends. Any amount of the qualifying loan interest that you have, this is the place you have to enter it into and you will deduct. All of this explanation that I have been doing it is written over here. If I have to show to all of you, check this out. There are 2 reliefs to be deducted from total income to arrive at net income. And these are those 2. The loss relief will be discussed later in notes, as I told you. Qualifying loan interest is what we are discussing. What makes the loan to say qualifying? You people already have seen qualifying purposes. But basic thing is that you have to keep into your mind, the money has to be used professionally, business reason. Amount that's being paid actually will be a deduction, because we don't follow accruals for tax. What they have actually paid will be a deduction. This is the sequence that we have to follow. Other income first, savings on to the next, the dividends into the last. That's what I've told you, that you must have to go with the flow. You must have to start deducting the qualifying loan interest from the other income column first. Savings on to the next, dividends into the last. That's what's been written over and have been able to even explain and show to all of you. That means now after deducting this out, we are at the level of net income. What comes very next to is personal allowance. If I try to show to back all of you on the lecture notes by bringing that performer in front, see, this is the level that we are now at. And what makes the income to say taxable? A deduction of personal allowance. After, the income is said to be as taxable. Before, the income is said to be as net. So what is personal allowance and what it does and what is the limit of it? Personal allowance acts as an exemption, like the people in the past have been getting the benefit of annual exemptions for capital gains tax, for inheritance tax. It's like an annual exemption of income tax, but we call it as personal allowance. For tax year 21-22, the limit of that is 12570, quite much close to the annual exemption of capital gains, 12300. So suppose I have a net income of 20,000 with a deduction of personal allowance of 12570. This much of income will become tax-free. This much of income will become tax-free, 20,000 minus 12570. This much of income becomes tax-free. I was supposed to pay a tax on this one, but I will end up paying tax onto this. This much of income now has become tax-free. And this is a fixed limit for tax year 21-22. The question does not have to tell us about, we by default has to be done. And once again, if I discuss the same case above onto it, as above, the level of income a little less than to what we have onto the allowance side, then are we going to get any benefit of that further than this? Suppose the net income is just about a 9,000 figure. So will I be able to deduct the whole of that amount? No. I will be able to possibly deduct the amount as equal to the income that I have, which is 9,000. So the portion of personal allowance that has not been relieved is called as unrelieved personal allowance and will totally be a waste. Which in this case is 9,000 minus 12570, 3570. This will totally be a waste, cannot do anything about. For inheritance tax topic, people have seen the exemption we carry forward to one tax year. For capital gains, we cannot. Even for personal allowance, we cannot. That's been written on the top, the next page, that it is a tax-free lump sum allowance, reduces the income by a figure of this much for tax year 21-22. Any unrelieved personal allowance will be a waste, can never be carried forward to take any sort of further advantage. Okay with this? There's a little bit of talk we have to do it in a continuation of personal allowance. It's called as reduced personal allowance. Reduced personal allowance. When will this reduction to be achieved and how? It says if the ANI is more than £200,000, the reduction will be achieved. What is ANI? ANI stands for adjusted, N stands for net, I stands for income. So if ANI is more than £200,000, the reduction will be achieved. How will it be achieved? We will write the personal allowance 125700, and then we will achieve that reduction by using that formula. ANI minus 100,000 at the rate of 50%. Whatever the revised answer we will get, the one we will be able to use. So this reduction will only be applied when the ANI has to be more than 200,000. When the ANI is less than or equals to 100,000, we will accept the allowance as original. But if it is more, that's the way to achieve the reduction. So what is ANI? This I also can explain. What is ANI? ANI takes the total net income less two of the adjustments. See, the word is adjusted net income. It means it requires to have some adjustments in. So two adjustments: gross gift aid donations and gross personal pension scheme contributions. Not necessarily will be provided with these two. Then total net income will be the adjusted net income, or you may be provided with the one of the two. Topic wise, we will discuss this gift aid donations itself in chapter 1 in the end. And this will be studied later on in chapter number we do not have, but obviously the chapter of pensions. We will be discussing this in the topic of pensions. So today you should not be having this question mark, what is this gross BPS, what is this gross gift aid donation? Because topic wise, we will be having a words over to all of those things later. At least the focus of today has to be that if the question provides me with this piece of information, gross gift aid donation, gross BPS, then I should have to adjust it from the total net income balance to get me the answer of ANI, so that I can see if the ANI is more than to that mark for me to adjust or for me not to adjust. And that's been written all over. The personal allowance of this much will be reduced if the total net income adjusted is in excess over to that mark. Then you also can see if the ANI is less than or equals to 100,000, then we accept the allowance as it is. But if it is more, the reduction is achieved. And that's the way I have explained up to you. Personal allowance minus that reduction, ANI minus 100,000 taking the 50%. And ANI stands for the total net income minus the gross gift aid donation minus the gross personal pension scheme contributions. This can be revised well in application number 2 to end up this explanation also. Yeah, there's one thing that I've skipped on the way if you're wondering. That we will discuss it for the next week. We'll keep that discussion for the next week. Allocation of personal allowance is just another thing that I will definitely have to come and back and explain this to you. But that will happen in the next week. This discussion is about using the most beneficial order to deduct the personal allowance, because we have 3 columns to deduct the personal allowance. So should we follow the sequence of as it's written? No, we can elect to deduct the personal allowance either from this column first or against this column on the next, and thirdly over here. Or we may only use the one column to deduct the whole personal allowance from that side, and that column can be the third one, second one, first one. So this sort of planning thing, we will be doing it the next week. I haven't left it aside on the way. I have intentionally keep that
thing for the next course to start and freshly we will understand. And this we can complete it on the, we already have completed application 2 is what we have followed. Melina received an employment income of 50,000. She has made the personal pension scheme contributions of 35,000. So the employment income is provided, which is a figure of 150,000. The question does not provide us with any income except this. So I will have to come and subtract the personal allowance, which usually is 125700. May not be the case in this. So for that reason, I will have to try and calculate the ANI first. What is ANI? ANI is total net income, which in this case is 150,000, and gross personal pension scheme contribution, which in this case is given as 35,000. So this is the ANI we have ended up working. This is the ANI that we've ended up working. This ANI is definitely more than to that 100,000 mark. Therefore, we will have to come and achieve that reduction. Let's go to achieve it. The personal allowance 12570. That reduction, which will allow me to use the ANI balance 115,000 minus 100,000, taking the 50% of it. Taking the 50% of it. So 115,000 minus 100,000. Taking the 50% of that, the figure has to be 7,500. 570, the figure has turned up to be 5070. This is the amount that I will be able to use it up there. One 44930. Okay. So the figure is 12570. This time it has turned out to be 507. All because of that process of achieving the reduction. For me to find the ANI, I need to first of all work this ANI thing. When it turns out to be a balance more than 200,000, this is what we have to do. And once it's been revised, we have been able to use it up there. What would the change in Melina's total tax bill if she had received an employment income of 177,000? So that will require me to copy. That was a part A. Now they want us to solve the part B. So I can solve the part B by just changing the facts of it. So the employment income now has moved up to 177,000. While the personal pension contributions have not been changed. So 177 minus 35, the figure has to be 142,000. $142,000 minus 100,000. The 50% of that is 21,000.
and the personal allowance is 12570. Now, this is the situation where the allowance has turned out to be a negative figure, which effectively means no figure. Because allowance is something, else it's nothing, it's not a negative figure. So no allowance in that case, we will end up in zero. That's the next point I have finished. The deduction from the personal allowance can be achieved to the extent that it becomes a zero, cannot become a negative figure. So that pretty much also ends up this part, that at times when the allowances will require to have a bit of a reduction, I have been able to explain to you the whole process of it. Except this point of allocating the personal allowance to which income first, second, and third one, we've completed, and can say that the first half of the income tax return we've completed. Well, the second half is about computing the liability by using the band limits and rate, which all will be coming to our way in the next course. The course today has come to an end, 4 hours. We always take a course on Sunday and we start it off, we finish it off by when we do not realize how the time quickly passes on. We will expect to take some classes in addition to the Sunday, as from today, roughly about 2 months we are left. 2 months have already expired and we have not done any hardship, but we are expecting to do that the same in the month of September and October coming. Mentally, you have to feel ready about. Soon I will be sharing you a plan to have some courses over and above to our normal courses. If I put an additional class, it might be on weekdays in the evening, can be on Mondays, can be on Thursdays, can be on Fridays, probably on Thursdays. I also have to see my availability. And then alternatively, this can be changed. Can utilize the public holiday also. So from my side, I will work on to a plan and will share. Sooner or later, we will have to start taking more or less 2 courses a week. May not every time it happen, but roughly I can say we can expect to take about 2 courses a week. A lot of things we have still to complete. Practice of exams we also have to. Because 2 months now we are only targeting to finish this course within. Roughly, if I go to plan, in 2 weeks we can have the maximum sessions of 8 to 9. This needs to be taken up to say 15 to 16 sessions, means we'll have to try and double it. And we cannot take a long class in one day, 8-hour course on Sunday, because after 3 to 4 hours, we get exhausted. We try to always feel getting it out of the course. Not one day we can take a large course, long one. We'll rather have to split this into parts. One, if we can take it on Sunday, we'll probably expect to take the second one on Thursday in the evening, 6 p.m. onwards. Let me finish myself at my side with this whole homework of putting the classes for all of my batches. I will come back to you. We'll send you an email and also be briefing you on the next time we will meet up. And then from the next week and onwards, we will start implementing. Okay. So capital gains, tax, inheritance tax completed. Not going to touch ever in the course now. You people have been given everything what I have from my side, lecture notes, my resources, study text, revision kits, recordings. You have it with you. You use it, you don't use it at your side, that not totally is in your hands. Income tax is what we have started today. We will continue the same as the course is over. There is another topic we've done on the way, stamp taxes of 1 hour. You also have to complete it. 1 hour lecture with its board work and lecture notes. Okay, so I will see you the next Sunday to continue. Have a good time. Thank you very much.